you so much for joining in. A lot of our viewers are trying to understand what is happening at this juncture, and there are some explanations that are being floated, and perhaps a conversation with you will help them get some clarity. Deepak, I'll start with you. One of the points that is being raised is the possibility of margin calls being triggered, cash not being added by clients, and therefore securities being sold into. How plausible is that as an explanation?
Yeah, good afternoon. Now the Murat trading session of the last session, which we had previous session, and that session ended with gains. So in that sense, margin calls this morning will typically depend on the MTM losses till yesterday. So whatever losses have been made on the Murat trading session or prior to that, for that the margin calls will be made today. But I don't think that was a very big amount in any case, because Murat trading ended in the positive. Today, there is a fall in the market. So probably tomorrow morning, margin calls may happen in case markets don't recover by the end of the day and clients are not able to top up their MTM losses.
Gaurav, I want to understand that what is the kind of client exposure right now in terms of derivatives, and how much of that allocation is towards the longs?
So, I think most of the clients are not over leveraged. That's what we have seen. System has become extremely tight. So it is not like past when markets will fall by 200, 400, 500 points and it will trigger a massive kind of, margin calls and, so I don't think we are in this in this thing then kind of this market where margin calls is a trigger for a sharp fall in the market. What we see is that every year Nifty does go down by 8, 10%, 12%, and we have already we had just had a fall of around 9.5 percentage points from the peak. So I think this is something which most of the investors will this thing take in stride. The problem is in the small cap, micro cap space, some of the overheated spaces where the fall has been much the sharper. Stocks are down by 20, 25, 30% plus, and there you don't have margin funding. Okay, so I don't think margin funding or the squaring off is an issue as of now in the market. Yes, as the other participants said, tomorrow morning you might know the figures and it will not. I don't see it as a this thing very big issue unless the market keeps falling down like this for a couple of days, 2-3 days. Unless you see that, I don't see margins as an issue.
Fair point. Just help me understand further, Deepak, what the kind of behavior is that you're seeing with your clients right now. Because another kind of talking point has been that while we've seen the benchmarks drop, as Gaurav just pointed out, 9 percentage points odd for the benchmark Nifty 50, less so for the broader market benchmarks over that same period, we've seen a few stocks where you've seen sharper cracks. The point that is being raised is that positions are not being kept for long periods. Out of 10 positions, say for example, 2 are being kept, and so therefore this is not something that could exacerbate, and that lends itself to what Deepak is just talking about, or rather what Gaurav is just talking about. What would you tell us with regard to the behavior of your clients? Are they adding cash where required when margin calls are getting triggered?
So it will typically depend from client to client and their trade mix. So in case they are more sort of focused on derivatives or FNO, then probably at some point they will take a call that they have to get out, they have to square up and wait out for some time before they have a clearer view about the direction of the market. In case they are invested in the cash market, and most people will have money to sort of top up at times of weakness. So there also, I think people will continue with their cash positions. Very few will sort of want to exit their profit making and loss making both positions, try and square up them and sort of sit out for some time. But most cases, people will top up their losses, pay up their MTM losses, and wait out for better times to come. Unless, as Gaurav mentioned, the markets keeps falling day after day for the next 5, 7, 10 sessions. At which point the patience of the cash investors will also get tested.
Gaurav, you said that you might expect further fall in the markets. So, overall picture I want to understand. First off, do you think that the markets are oversold? And secondly, when do you expect this selling to overall take a pause or maybe take a stop, and thereafter we see a correction and we see some kind of positivity or some kind of green signals in the market going forward?
So yeah, I mean that's I don't have that kind of a skill to correctly predict the market for a day or half a day or 2 day. But then if you see in this fall, basically the large investors institutions are going short. That means there's likely to be more weakness in the market. Retail, on the other hand, today in the FNO have actually built up their long. So that is how the market is as of now looking. So I think if you expect some more weakness, that could be the case. However, where it will take the support is something I think we'll know in the hindsight only. But given the past history, as I said, 10 to 12% kind of a pullback in the Nifty happens every year. So that should not be honestly surprise to anyone.
Gaurav, just to follow up to you, of course, you can't project or predict when things will turn. Nobody can do that, really. But the question to you is there some element of spooking taking place based on the kind of global events that are just a day or two away, particularly the uncertainty with regard to the US elections, particularly in the context of the kind of selling 1.25 lakh crore on a provisional basis by foreign institutions in the Indian equity market?
So you mean, I think we have been extremely lucky and blessed in this fall because there was so much of strong domestic inflows that 1.5 lakh crores have been got absorbed with only this 8 to 9% fall in Nifty. So I think markets have done this thing pretty well in that sense. Secondly, I think markets, if you look for a leading indicator where they're going to stabilize, one is that, as I said, the retail will have to stop building longs, which I don't see as of now. Secondly, the India VIX index is still in green. Okay, so volatility index is going up. Unless you see first signs of India VIX actually cooling down, you cannot expect markets to stabilize. Okay, so I think these will be two basically indicators for everyone to look forward to.
Right. Deepak, just for viewers' context, I want you to explain that why has the India VIX gone up so much, and what is the kind of, trend that you expect going forward as well?
India VIX has gone up. I think it closed yesterday at about 16. It has remained in a band of about 12 to 16, 17 for quite some time. So in that sense, volatility, now currently it is at 17. So 12 to 17 is a normal band for the VIX. We are at the upper end of the band, no doubt. There is a event because of which the volatility is high. The US elections and US Fed meet and the result season. There are three things put together. So it's not surprising that the VIX is inching up. But historically, the VIX has gone up to much higher levels in the past. So compared to that, I think there's nothing to get overly worried about these levels of the VIX.
Fair point, Deepak. I'm just curious about the kind of selling that you're witnessing, whether it is concentrated in any specific pocket sector-wise, and in your opinion, are there any pockets that are poised for more selling where you anticipate that things could get worse?
So today, I think we have seen some weakness in the refining stocks because of a brokerage report which has sort of downgraded their rating on all the refining stocks. There is some selling in auto stocks, mainly because of the monthly sales number. Wholesale numbers have been good, but retail numbers, people are still awaiting as to how good or otherwise they have been. So from day to day, you will sort of get sectors which are under selling pressure or which are witnessing buying. Secondly, if there is a lot of FI selling happening, then typically it would be a basket selling in most cases, whereby all about 15 to 20 or 30 stocks will see selling pressure at a particular point of time, and the index will come under pressure. So a lot will depend on the near-term developments in the respective sectors, and that is how those sectors will get impacted either on the positive or a negative side.
But Deepak, I want to understand that the selling has been happening since the past few days. Do you see any sectors which has stood strong against the kind of selling that has already been happening in the markets? And do you expect those sectors to probably perform better as compared to what other sectors are seeing in terms of pressure?
Yeah, so I think two sectors stand out. One is BFSI and the other is IT. So they have sort of fallen less than the others, withstood the overall negative sentiments much better. And going forward also, I think we had slight negative news for the banking sector in the sense that the credit growth for the fortnight ended 18th October came in at 11.5%, which is at a multi-month low. So that is a slight negative for the BFSI. Otherwise, I think BFSI and IT could sort of outperform even in a downtrending market for some time.
Gaurav, do you want to add to that? And also, question is, how are you advising clients right now? Of course, it would depend on size, scale, and proclivity. But broadly, how are you advising your clients?
So, for about month and a half, we've been asking our clients to reduce exposure to small cap, micro cap stocks, momentum stocks, because, you have had a 17, 18 months of a one-way rally in the small cap index. And if you see the past 20, 25 years, on an average, a small cap rally lasts for around 18 months. So we had already had that. And maximum of small cap rally has gone for around 20, 21 months. So it was time where the risk reward was much better in this thing large caps compared to small caps, and this thing that is quite evident. Also, we were asking our clients to take home some profits in the spaces that has been doing well, like power, defense, railways, and stuff like that, where the valuations have become extremely overheated. So that has been our stand for past 1.5 month, 2 months. Now, talking about the spaces which are doing well, which are not doing well, I think they are very closely linked to what happened in Q2 earnings. We've been talking about events, but we haven't talked about how the earning growth has slowed down. Started in Q1, and it is very evident again in Q2. So the biggest disappointment which has come here is that the consumer spending has slowed down. Rural was supposed to pick up, which has actually not happened. Urban spending is also weak. So if you see, basically FMCG, autos have been largely underperformers. On the other hand, we have seen asset quality issues in case of NBFC. So that is also a space which have been the worst hit. So this is all linked to what have been the outcome of Q2 results. On the other hand, what we have seen is that some of these private banks, some of these basically this real estate companies, IT companies, which have shown uh, decent numbers and given a better outlook of growth, have been actually been the outperformers.
Right. Okay. And thanks for that summation. Deepak, last thoughts from your side. I've asked Gaurav already what he's been advising or his team has been advising clients. Do you want to add to that? What have you been telling your clients?
Yeah, so blind investing in micro, small, and mid cap stocks to be typically avoided. That goes without saying. And but at the same time, one has to realize that small and mid caps will give you the best alpha. If you don't want to if you want to stay away from small and mid caps forever, then probably you should go to mutual funds, the large cap mutual funds or the index mutual funds. So you will have to be on the lookout for stories within the small and mid caps where the stocks have come to an attractive level vis-a-vis the growth expectation of their earnings, and take baby steps or do SIP investing in those stocks. Monitor them very closely, look out for any red flags continuously, and when you think that their valuations have gone beyond what the bull markets also deserve, then better to start unloading gradually from those stocks.
Deepak, Gaurav spoke about earnings. I'm curious about what you made of that, because there have been a few very key disappointments. In fact, if I look at the development today itself, and Gaurav did mention that in the auto pack, wholesale numbers are a bit of a disappointment in certain pockets, and that's evident in the way that the stocks are getting battered a little bit, right? So what did you make of the areas where you were most disappointment or most disappointed, and are there areas where you're seeing that it's a blind buy at this juncture based on the earnings that you've seen? They were better than you expected and valuations have corrected, and so it's a blind buy?
So earnings this time around, I think the profit growth will come at a multi-quarter, 16, 17 quarter low. So in that sense, there may not be any blind buys as such in terms of sectors. It is all very, very relative. Now, the commodity-based sectors have performed the worst, whether it is metals, oil and gas, cement, chemicals, etc. So they have performed the worst. So going forward, I think one will have to look at whether these commodity plays are reaching any attractive levels, so that you can ride the bounce or maybe the next big run. And a lot will depend on how the Chinese economy starts behaving from now on, based on the stimulus measures which have already been announced and some of which are expected from here on.
Just want to point out very quickly that we are off the low point of the day, gentlemen. You're obviously looking at your screens as I am right now. We're down about 1.5% for the Nifty 50, as compared with 2% when we started this conversation, or thereabouts. Actually, at 11:30 or thereabouts, we're at 2% down.
Right. Yeah. I think, Alex, another pocket which is seeing significant pressure today is the oil and gas space, and it's down almost around 3.5 odd percent. But it, like markets are recovering. Even Nifty oil and gas has recovered from its day's lows and currently trading around 2.8% lower. But Gaurav, I want to understand overall, a lot of things are not working for OMCs. Brent prices have been up around 4%. Q2 earnings have been weak for all of these OMCs. Production outlook overall remains uncertain. So your outlook on all of these OMCs, and how does one play with these stocks at present?
Right now in the oil and gas space, what we have been talking about, recommending to our clients, and what we like is the entire companies in the in this gas chains, okay, right from this Petronet LNG to GAIL to this thing IGL, NGL. So I think there is a space which don't get constantly or regularly affected by the this thing regulatory changes. So that's where we see this thing value. This thing, valuations are also on our side. So that's where we've been focused. OMCs have become extremely volatile because of the volatility in the crude oil prices, and that makes it very, very tough to take a buy and hold call.
That's a fair point. Deepak, Gaurav, thank you so much for joining in, for the perspective that you gave us, most insightful. And on a day like today, our viewers will certainly appreciate the time that you've spent with us.
My pleasure.
All right, now let's very quickly take you through what we have not spoken about while we were speaking to those two gentlemen. And the fact is that, and we were pointing it out very quickly, but let's take a little bit of a closer look at the patchwork right now that we were showing you on the screen in terms of sectoral performance. You'll see VIX is still elevated. It's up about 6% or thereabouts, but you have the Nifty IT that is currently, has come off. It's down about 1/3%, and that was what Deepak was just mentioning in terms of the stocks that have not gotten beaten out as much. BFSI not to that extent. It's still down, the Nifty Bank down about 1% or so. But you have oil and gas that is one of the pain points in trade today. And let's talk about OMCs as well as gas stocks. And this is also on the back of the commercial LPG cylinder price hike. That is also playing into the kind of reaction that you're seeing in the stock markets today. Mika is joining in to tell you about the potential impact on the OMCs if this hike, or rather of this hike. Mika, what can you tell us?
Good afternoon, Alex. So, you have the Nifty oil and gas down about 3.8% intraday. When you talk about the top losers, you have companies like IOCL, BPCL, HPCL, and Reliance Industries. And the Indian oil marketing companies have fallen over 4% intraday. Now, when you talk about what's not working for the OMCs, well, up first is the volatility in Brent prices. While they do stand lower on a one-year basis, they have seen almost a 4% uptick in the past week itself. And the OMCs also posted a weak Q2 earnings. They have extended LPG losses. Now, they did announce a commercial price hike by 62 rupees for the 19 kg cylinder. However, when you talk about, while this could offer some relief on the LPG losses that the companies have been facing, they have been facing majorly losses on the retail part of it, which is currently played on a subsidized race. So the market's not, you can see while this would be positive for the realizations, the stocks have corrected. When you talk about what's not working for Oil India and ONGC, well, production outlook remains uncertain. The companies are yet to post their Q2 results. And lastly, when you look at the city gas company pack, well, IGL, MGL, GGL are all fallen 2 to 4% on an intraday basis. One of the major headwinds for the sector is the lower APM gas allocation, which impacts their operating costs and thereby their profitability. Analysts also expect near-term margins to remain under pressure, and the PNGRB notice to end network exclusivity is also a key overhang.
Yeah, thanks so much for putting that into perspective for us, Mika. And certainly those stocks are among the worst hit, particularly in the large cap space, if you were to look at it. And some of those stocks will play on the screen. But one key aspect this week, apart from everything that you're seeing in the global space, talking about US elections and Fed meet and everything else, action in the primary market in India is certainly something to watch for. And it's something that Mahima is tracking very closely. The Swiggy IPO, a lot of people have been speaking about it for so long, particularly because of the interest that celebrities have had over the last 3 or 4 months, people trying to get in early. Right. But that issue, the size of the issue has actually shrunk a couple of times. It is at what, 11,300 odd crore rupees, and it's a tough week for them to launch their issue.
Absolutely, absolutely. It's a tough week, but the interesting part is that Zomato will now have a peer to compare with. So it's probably good for the entire quick commerce and the food delivery space overall. Just to give a brief about the IPO details, the Swiggy IPO will open for subscription on 6th of November and end on 8th of November. November. The issue price is set between 371 to 390. It has a fresh issue of 4,499 crores and OFS stands at around 6,828 crores. So the total issue, as Alex rightly mentioned, stands around 11,327 crores. Now the market value as per upper band stands around 87,299 crores. Now in terms of how these proceeds will be used by Swiggy management, well, they'll be repaying the Skutsi borrowings of around 164 crores. Further, they'll be expanding their dark stores and will be investing around 1178 crores there. They will also be investing in technology by around 700 odd crores, and further they'll be investing in branding and marketing and promotional spends of around 1115 crores. Now in terms of the financial metrics, when it comes to talking about the Swiggy IPO, it's but natural that we have to compare it to Zomato.
But the sticking point, Mahima, is going to be the fact that they are not yet profitable, and it's going to take quite a bit for them to be profitable, and so therefore will the street have the kind of patience that they would anticipate or hope that the street would have to wait for 5-6 quarters for a profitable turnaround?
Absolutely. So the analysts suggest that it's around 5 to 6 quarters away from being profitable. So that's one of the pain points for Swiggy right now. But the street might take it positively because it is coming at a lower valuation as compared to Zomato. So that's the plus point for the Swiggy IPO. In terms of financial metrics, as you rightly mentioned, it's around 4 to 6 quarters away from turning EBITDA positive. Currently in Q1, it had a negative EBITDA of around 544 crores. And overall, in terms of metrics also, if we see, they have been improving in terms of FY24 to Q1, even in terms of contribution margins. Swiggy's performance metrics have been improving. So that's a positive definitely for Swiggy IPO.
Let's see what
because with the kind of swelling that we are seeing, it'll definitely be an interesting thing to watch.
And even at this juncture, despite the kind of drop in prices, Zomato is still one of the stocks of the year. So we'll have to see how Zomato also reacts once Swiggy comes through.
Absolutely.
But with that, we're completely out of time on this particular edition of Ask Profit. From Mahima and myself and the team that put the show together, thank you so much for watching. Do stay tuned. This is NDTV Profit.
Market veteran Ramesh Damani puts on the cephalogist's hat to get you the insight you need on the US presidential battle of the century. Will Kamala Harris claim a historic victory, or will Donald Trump march back into the White House?
According to polls, if Biden and Trump were running, I think Trump would have handily won. He was almost measuring the drapes to the White House even before the election.
What are the stakes for India and its investors?
The road to the 1600 Pennsylvania Avenue goes through Pennsylvania this time.
Tune in to US Election Watch with Ramesh Damani exclusively on the NDTV network.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow, the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day.
and welcome to NDTV Profit. My name is Varsha and Biocon will be in focus today. So company came out with its Q2 FY25 numbers, wherein if you see revenue was up 4% while EBITDA was down 7%. Net profit was down 84%. Now this was on the back of higher tax outgo. Well, to speak about the numbers, I am here joined by Mr. Shreyas Tambe, who is the CEO and MD of Biocon Biologics. Hello Shreyas, welcome to the show.
Hi Varsha, thank you for having me on the show.
Well, Shreyas, weak generics performance have eroded overall growth and margin for the business. Can we see improvement in H2 FY25, and if yes, what are the levers? And I was just seeing that biosimilar sales were up 4% quarter on quarter. So what's the outlook there also?
Yeah, I mean, I wouldn't specifically talk on the generics business, but let me say that, we have commented about, there's a lot of promise in that business too, in terms of the product portfolio that we've got, the peptide portfolio that we are bringing to market. We're the only ones who have approval for that product at this point in time in the UK, and we're looking to launch that product. So I think we have a lot of promise in that. We have leadership positions in some of our immunosuppressant portfolio. But obviously, there is a pricing pressure in some of these generic molecules, and that's something that we will have to overcome. We've been very resilient over the years, and the generics business will pick up as time goes by. Coming specifically to biologics, which is the business that I can talk to you more specifically about, we have had a very strong quarter again, where business has grown 19% on a like-for-like basis year on year. And that is something that we're very, very happy about, because this growth was not just in revenues, but it's also been a strong, profitable growth, with our core EBITDAs being in the 30s, and the EBITDA margins in the 20s, which has been a very strong performance, which sets us up very nicely for the second half of the year.
All right, understood. And also I wanted to understand this, as far as Biocon Biologics is considered, the core EBITDA margin has decreased, let's say, quarter on quarter. So is the OPEX which has increased quarter over quarter?
Well, actually, the core EBITDA margins move on a like-for-like basis is what you need to see. If you remember, last year, this time, we also had a couple of other businesses that we monetized. For example, the India branded formulations business was another business that we had at that point in time, which we have monetized. So some of these adjustments, when you look at that, our core EBITDA actually is comparable. It's in fact the gross margins are better than last year same time. So we feel good about how the business has grown, Varsha.
All right. Now, what insights can you just share about the traction in the biosimilar business? Now, considering the pipeline that you have got and the upcoming Stelara biosimilar for commercialization in Q4, what are the key catalysts do you anticipate over the next 3 years, particularly in FY27?
Yeah, and that's a very, very, very strategic and important question that you ask. Let me start by first talking about the products that we already have in the market. And that's a good way to answer the question that you talked about. And we're very happy to tell you that the products that we've commercialized today, after we acquired the business from Viatris, it's coming up on the first year anniversary after we integrated that business at the end of this calendar year, has shown a very strong performance, where in the United States, which is one of the large markets, 40% of our business comes from there. We have seen a fifth of the market share has been with our products. So it shows that the oncology space, that we have two products in, both products exceed 20% market share. The one insulin product that we've got, the insulin glargine, has close to 20% of the market. We've done exceedingly well in some countries in Europe, which is important for us for our adalimumab franchise. So we feel very good on the platform that we've set up in terms of taking us forward for growth. Emerging markets, we have decided to focus on 8 to 10 countries, and our market shares there also continue to grow. So what is it for us in the next 2 to 3 years? You've set a horizon on FY27. Well, the important thing for us is we are positioned very, very favorably at this point in time. We are one of the few companies at this stage in the industry which is looking to launch about 5 products in the next 2 to 3 years. So that is very unique. Biocon Biologics has always been a science-driven company. We have excelled and we performed because we've been a science-driven company. We have several firsts to our name, and the next 2 years or 3 years that you see with the time frame that you said, we are looking to launch 5 products in that time frame. You talked specifically about Stellara biosimilar, and we have reached a very favorable settlement with the originator in this case, so that we can be amongst the first wave of products that are launched in the United States. We will look to launch this product in the UK, in EU, in Canada, because we've reached favorable settlements there as well, including in Japan. So we feel that this will be another product that we will bring in the immunology space, a franchise that we're very familiar with, given the performance of polio in Europe, and we look to build on that in the coming couple of years.
Understood. Also, any comment on the pricing aspects, as prices are more competitive as market is moving towards biosimilars?
Well, I think the first thing, Varsha, we need to be cognizant of is pricing is an artifact of the market, and it'll always be there because there will be competition. And if we are expecting to be successful, we need to be ready to deal with competition. We have, for a very large part of how we've grown the company, we've been a emerging markets player, which is very, very frugal in terms of how it approaches on its cost structure, and it's very price sensitive in terms of its affordability index. That is something that has driven us as a company. So we don't necessarily look at pricing as a challenge for us to move forward. In fact, we look at it as a differentiator, because we believe that we have one of the most cost competitive setups and positions us better than most of our peers in this space.
Okay. Also, regarding your recent debt refinancing, now what is the kind of finance cost for the newly added debt? If you could, update us with that.
Yeah, and of course the finance cost is an important question, because that is what you report on that. But let me tell you a little bit about this, because this is a very strategic development. It wasn't just for the coupon that is, of course, lower than what it was before. So we have a lower cost of financing than what we had in the past. But more importantly, if we look at it, why did we do this? It was important to do this restructuring so that it allowed us to focus more on the business rather than focus on servicing the debt. So the long-term debt that now we've got through the US bond, US dollar bond, which is now listed on the Singapore Stock Exchange, is also a confidence building measure where more than 50% of our investors are US based. And it's been oversubscribed for over 3 times, which tells you that there's a lot of confidence that the investor base that we've got has for the story that we are trying to build, the business that we have built so far, and the promise that it holds for the future. Now, specifically answering the question that you asked, how is the coupon placed? Well, the cost of the financing of this is, let me tell you, lower than what it was when we first financed the acquisition debt, and certainly lower in terms of servicing it, both in terms of the bond itself and in terms of the syndicated loan that we've now refinanced as well. So on all, not just the cost, but strategically, I think it has been a very, very important move for Biocon Biologics.
Understood. Now my last question, Shreyas, to you would be, can we expect IPO when it comes to Biocon Biologics? What are the timelines, or any kind of guidance that you can give?
Yeah, and I know that this keeps coming up every other time, and there's a lot of interest in that as well. I think the bond issuance, of course, tells you that interest is very solid and strong. And we have guided in the past as well that we will be looking to unlock value in Biocon Biologics at the right time. We, of course, needed to first consolidate the business, which is what fiscal 25 has been. We have, of course, integrated it, which means whatever we acquired from Beatrice, we've integrated it into Biocon Biologics. But we need to consolidate it. We need to be in control of that business before we accelerate it for growth. And then we can talk about the IPO so that it creates value for all stakeholders. So it's not just about unlocking value, but also creating value for everyone who is invested in this phenomenal growth story.
Hello and welcome. Thanks for staying with us on Hot Money here on NDTV Profit. I'm Harsh Saita. With me is Anushi Vakharia. And over the next 20 odd minutes, we'll speak with the management as well as try and get perspective on many of the counters. Let me bring on board Ashish Maheshwari, Director at Arihant Capital Markets, to also talk to us and give us more perspective on some of the stocks which are buzzing in trade. First off, Ashish, I want to talk to you with regard to this reversal that's happened with regard to loan growth and deposit growth. We've seen deposit growth outpace loan growth first quarter since 2022 April that this has happened. Stocks largely in the private sector banking space where things could change as a result of this. Just talk us through how big this is for you or not as much. Give us your perspective and also tell us which stocks primarily will be on your radar on the back of this trend starting.
As far as this disequilibrium of deposit growth versus credit growth discussion and is there in the banking sector, in my view, now as the markets, as stock markets are taking slightly a beating, so maybe retail investors' deposit will again start flowing towards the banking sector as such, number one. Number two, now some deposit growth is envisaged because now deposit rates are also going up. When you are getting almost 7.5%, 8% fixed deposit returns, so surely some money will again go in the banking channel because other sector will start looking risky. Third is again as the real estate prices and the gold prices are also getting higher. So I'm expecting that some reverse flow from other sector investing now will again flow in the banking sector as such. And the fourth is again as rural economy is showing some offshoot of picking up while looking at the numbers of Mahindra and Mahindra tractor sales and other companies which operate in primarily in that area. So there a lot of money only find its way or the saving find its way through banking channels. So some of the deposit growth I'm expecting now will start coming in from this quarter. As far as credit growth is concerned, again in the MFI sector, like what your Jivans or ISAF or Credit Access Gram, etc., are showing a lot of stress there in these kind of unsecured lending. So in that particular sector, I'm not that upbeat for those companies and banks. But I think the frontline banks here like Axis, HDFC, ICICI Bank, they will continue to do well in times to come.
Okay, from the banking space, we shift our focus to the defense space, wherein Zen Technologies have reported their Q2 numbers yesterday and the revenue over this weekend. And the numbers, strong set of numbers we are looking at. Revenue about 3.6 times of growth, margins at 33.1% compared to 28.5%, and net profit up over 4.7 times this quarter. Orders stood at about 956 crores. But to discuss more on the outlook, on the results and more, we are joined in by Mr. Ashok Atluri, the Chairman and Managing Director of Zen Technologies. Hello and welcome to the show, Mr. Atluri. First of all, great set of numbers that we are looking at. What to understand from here on, what's the outlook forward? How is the quarter gone by for you? You've seen about 3 times of growth in your revenues itself. Do we expect to see a revision in the 900 crore of guidance that you've given for FY25?
Yeah, thank you so much. Yeah, we expect that 900 crores is the target that we'll be able to reach this year. And the strong numbers will continue into the next 2 quarters also. And again, we think additional orders will come during the end of third quarter and the fourth quarter. And that should give us growth for the subsequent year also.
Mr. Atluri, what keeps the guidance more more slightly on the softer side, because you've done 500 crore in terms of H1 top line. Likely, will you beat that 900 crore guidance that you've given for full year?
Last year, we said 450 crores, but we did 430 crores.
Right.
So, so I don't want to take the flak for that again. So,
sure.
Let me be conservative here. Yeah.
Fair point. So fine. So being a little bit conservative, nothing wrong with that. But give us perspective. So your glide path is to do 3,000 crore by FY28. That's your essential guidance. In terms of new products, how many new products will come on stream in your view till then? And just in terms of what component or what mix will those new products command in that 3,000 crore top line?
So, one thing, just I want to reiterate that, we are in two segments. One is training and simulation, and the second is anti-drone systems. And again, the current scenario worldwide is, especially after the Ukraine-Russia war, Ukraine having the world's latest equipment, but still losing a battle against Russia, which is probably having dated equipment. The reason is again saying that, it's the man, not the machine, that will help in a war. That means to say training has a very significant role in things. So earlier it used to be just focus on buying newer equipment, the latest toy and the thing. But now it has suddenly become worldwide, not only in India, the training is important. So we expect the training to really increase in demand. The second is anti-drone system. As somebody tweeted today, it is no longer a nuclear superpower, it is the drone superpowers we are talking about. Now, whoever has better drones will be able to do. So how do you protect yourself against these drones? We have seen it in Armenia-Azerbaijan war, we have seen it in Ukraine. So anti-drone systems that we have developed are absolutely top of the class in the world, and so are the simulators. So we are in this sweet intersection where the growth for the existing product itself is very huge. With respect to the new products that we are launching, we are looking at increasing the scope of the product that we have. So we have launched this anti-drone system, remote control weapon station, the camera which goes with them. But we are also finding the independent market for the remote control weapon station in addition to the anti-drone solution that we are offering. So we expect that the products that we are organically growing itself will be able to give us the 50% CAGR growth that we are seeing for the next 3 years.
Mr. Atluri, of the strong growth that you've reported in Q2 on the revenue side, want to understand what was the outlook on exports. Last quarter, there was no recognition of exports which had taken place. So just wanted to understand what's your outlook on exports, how the margin profiles differ between the domestic and the export orders. Can you just give us an outline on both of these aspects?
So we are saying that out of the 900 crores, at least 300 crores will be exports. That's about one third will be exports. And the second is that your margins for the exports are a little higher than the domestic, because of the the distance, the ability to maintain, etc. We charge a little premium for the export market, and we think that premium will be commanded. Again, we compete there with a lot of foreign companies, and we are. Again, our objective is to supply the best product in the world at the best price to the customer. So the customers are very happy with the price that we're giving. We expect the export orders also to scale up in spite of the premium that we are charging.
Right, sir. Sir, tell us, you suggest that the current products will drive your top line from the 900 crore guidance in FY25 to 3,000 crore in FY28. What are the new products you're investing in? And what do you believe is the competition and the traction in those products that we can expect, and when do they come on stream?
So, the additional investment has been both in terms of, making some more simulators for the new upcoming weapon system that we have. And second is the anti-drone system. We are looking at the evolving threats that are coming, that our customers are facing, and developing in collaboration with them based on the live feedback that they are giving. So, these two factors are helping us, scale the existing products. And we do think there will be some launches, some R&D is going on, which would be premature to announce now, but definitely products which will be associated with these two things will be launched in and definitely I've factored those products also for the growth. But I think the growth stands strong at this point in time.
So, Mr. Atluri, of these new launches that are expected to take place, what is the kind of contribution that they will have on the top line from next year onwards? Can you give us more details on that? And is the margin profile in the 33 to 35% for these new products as well?
So, as I said that, for anti-drone systems, we are just strengthening the complete thing. For example, the remote control weapon station and the camera, etc. So we are thinking that, ideal combination as of now, almost 40% is from anti-drone systems, 60% from simulators. We expect that, this may go up to 50%. And, that the demand for anti-drone systems is increasing rapidly. But again, I would be very surprised I would not be very surprised if large number of training simulator orders come, and the current skew in favor of simulator continues. But again, to be very to say that I'm not very sure how the division between these things will happen, but they may be between 40 to 60% for both the products.
Right. Mr. Atluri, how much do you all spend on R&D as a percentage of top line? Or is there some kind of metric or thought process internally as to what kind of number would you be penciling in and spending?
So actually, as a percentage, it's generally very bureaucratic thing. We do, people spend it as say 8%, and then they go and make it 9%. It's a typical bureaucratic approach. But what we are doing is we are very opportunistic, that we get a good product to develop, we invest. So, at this point in time, I think this year we'll be investing something like 30 plus crores. But the fact is that if we get a good opportunity, again, Zen is very focused in long-term growth of the company. And we have been spending, we have 150 plus patents that we have applied for. Out of that, almost 80 have been granted at this point in time. They're not only Indian, but global patents. So we are into this R&D mode, and we will spend whatever is required to maintain the edge for the existing product and to develop new products whenever they are required. But this percentage is a very, very bureaucratic term. So we don't fix a percentage. We are very, very open to good opportunities, and we are very opportunistic about that.
No, great to hear, sir. And the other piece, how do you all account for that? Is that expensed out completely?
Yeah, so we are very conservative. Again, we expense out in the same quarter that it occurs. So so there is no question of because that's a very gray area, and for us gray is basically black, so we avoid that.
Okay, Mr. Atluri, in the quarter gone by, your order book stands at about 960 crore. Want to understand what were the order inflows for this quarter, and are you in track to achieve the guidance of 1,250 to 1,000 crore of order inflow target that you've given? Because the H2 is usually stronger. You've said that Q3 and Q4 you expect a ramp up in this order. So just wanted to understand more on this side.
Yeah, so we expect the orders to come into, the last quarter we had a AMC order, I think it was around 40 crores. But we expect more orders to come in the end of the third quarter and the fourth quarter, which will help us to reach the growth target that we have for FY26.
Okay, thank you so much, Mr. Atluri, for joining us and giving us all of that perspective. Stock obviously doing decently well on an otherwise, pretty tough day for markets overall. 0.25% higher as we speak. I still have with me Ashish Maheshwari. Ashish, just talk to us about this one. 17,000 crore in terms of market cap, 85 times in terms of price to earnings trailing 12 months, looking to do maybe 4x of what it's done trailing 12 months top line. How's it looking in terms of valuations to you, and would you go in and buy a Zen Tech? Ashish, believe you're on mute.
I'll start with the disclaimer that this stock I'm holding in my portfolio also.
Sure.
So, as far as Zen Technology numbers are concerned or the valuations are concerned, I think numbers are in line what market was expecting. And guidelines also, like how you have also highlighted, they have already done 500 odd crores, and next 6 months, in fact, should be better. So I'm expecting 1,000 crore they should touch in this year. In fact, should surpass that number first. I think only thing that market slightly nervous on the company. Like in last few months, there's no major order win announcement from the company. So whatever the order backlog is there, I think company is trying to meet those numbers. So valuations are rich for this company as far as the numbers are concerned. But if you see the kind of growth, almost every year they have doubled their profit. And I'm expecting in next 3 years also almost 35% CAGR will be there because the kind of innovative products and this anti-drone technology company is working on. There's a very good market for exports as well as in Indian market. So I'm bullish as far as Zen Technologies is concerned with the price target of 2,200 in next 6 months.
Okay, so positive stance on Zen Tech, but another stock which is buzzing is Azad Engineering. Now, this is after the company has signed a 5-year pact with Mitsubishi Heavy Industries for about a 700 crore of an order consideration. Want to understand, Ashish, from you, what is your view on Azad Engineering, especially considering that the valuations over this one is relatively expensive compared to its peers?
Yes, valuations are expensive, but only thing is that this is again a company working in a very niche area, so they will always get higher valuation, number one. And this, I think, this 700 crore order from Mitsubishi for long-term contract is again will keep some momentum in the stock. Though we have already seen valuations have subsided from the highs of almost 1900 rupees, stock came down to 1500 rupees. But still looking at the institutional holding and consistency in winning new orders as well as the performance, I think momentum will continue in this stock. So my suggestion will be to hold this particular stock, and in fact, it should be bought in any decline.
Okay, thanks so much, Ashish. It's been a packed show, frankly. Thanks so much for joining us as well as giving us all of that perspective. It's been a tight show, actually. But with that, out of time on this one, from Anushi, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
Market veteran Ramesh Damani puts on the cephalogist's hat to get you the insight you need on the US presidential battle of the century. Will Kamala Harris claim a historic victory, or will Donald Trump march back into the White House?
According to polls, if Biden and Trump were running, I think Trump would have handily won. He was almost measuring the drapes to the White House even before the election.
What are the stakes for India and its investors?
The road to the 1600 Pennsylvania Avenue goes through Pennsylvania this time.
Tune in to US Election Watch with Ramesh Damani, exclusively on the NDTV network.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro,
are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Nifty slips under 24,000 for the first time in 4 months as RIL and HDFC Bank contribute to the decline. Meanwhile, the rupee weakens further amid consistent selling activity from foreign institutional investors. All sectors trade in a sea of red. Nifty oil and gas is the top sectoral loser, followed by realty. Metals and banks down over 2% each. Nifty oil and gas tumbles over 3.8%. It is a top sectoral loser as companies face heat from soaring Brent prices and weak Q2 earnings. The post-Diwali week promises to be a bustling primary market as Swiggy, Sagility, Acme Solar and Nivabupa prepare for a major IPO launch. Ruckus erupts in Jammu and Kashmir Assembly as PTA lawmaker Wahid Parra tables resolution against Article 370 scrapping amidst BJP opposition. The Assembly held its first sitting in 6 years. Hello and welcome. Good afternoon. I am Malika Mishra. You're watching Market IQ. The markets are in a feel-fall mode today, and Harsh is joining me to tell us what's happening with the market.
Well, 2% lower, Malika. It's a tough day for markets. Let's pull up the Nifty 50 intraday chart, and we'll see that the weakness has sustained. That's how it's really playing out. Let's pull up in terms of the advanced decline as well as in terms of contributors. Just about 5 advances on the Nifty 50 versus 45 declines. The advanced decline showing and reflecting that weakness even in terms of the breadth. The contributors, just about 5 contributors in the green. M&M being the top contributor in terms of positives, but outside of that, Tech Mahindra, Cipla, IndusInd Bank just contributing marginally to the index. Of course, you're seeing some very heavy weights, ICICI, HDFC, Reliance, L&T contributing to the negative side of the Nifty. And it's not just the benchmark itself. You're seeing even broader markets facing quite a bit of pressure. The Nifty mid cap is down 1.6 odd %. The Nifty small cap also down, or rather mid cap down 1.5%. Nifty small cap down 2% in trade. So it's essentially across the market, the breadth itself being extremely weak. The India VIX is up 8% in trade today. So clearly volatility spiking. In terms of sectors, you're seeing a % lower on the Nifty Bank, but outside of the Nifty Bank and Nifty IT, which is down around 0.5%, you're seeing more than 1% in terms of declines across all other indices. So there's pressure across the board. You're seeing something like a Nifty Metal down 2.5%. You're seeing 3% down on the Nifty Realty, as Malika said, and even the oil and gas index is down 3% plus. So if we can have a snapshot of that in terms of all sectors, you'll see that pretty much all sectors in the decline and sharply lower. So you're seeing pressure across the board. Maybe on top of that, if you can see Nifty IT, maybe Nifty Bank in the top, on the top front row of that heat map. Outside of that, you're seeing pressure pretty much across the board. So not looking pretty at all. And Malika, that's currently how the texture is playing out.
Well, thank you so much for that market wrap. Now, the rupee today weakened by 3 paise to a record low of 84.11 against the US dollar. And this is for the second time in a row where it closed at 84.08 on Friday last week. Now, this fall is largely being speculated on the back of massive FII selling. To discuss this fall and more, I'm being joined by Anindya Banerjee of Kotak Securities. Sir, can you hear me?
Yes, I can.
Good afternoon. Yes, you are. Good afternoon, sir. Welcome to the show. As I said in my intro, Rupee has been falling to record lows, and this is being speculated on the back of FII selling and the RBI possibly not as aggressively defending the rupee. What is your take on this?
Thank you for having me. A very good afternoon. Yes, the Indian rupee has hit a low, but if we take a step back and look at how the other currencies have done over this year. So Indian rupee has depreciated around 1% since the start of this year. And if you look at index called the dollar index, it has appreciated somewhere around 3%. So Indian rupee has actually done better than a lot of its peers. So it's kind of an outperformer yet, in spite of the fact that it's still at an all-time low. So because of the FPI outflows, it's definitely putting a lot of pressure on the rupee, because for the month of October, the outflows have been close to $12 billion. It's just reversing the entire flows which came in September. But at the same time, RBI has been selling dollars, and which is evident from the fact that the FX reserves have come down. So RBI has enough pretty large war chest, and they will continue to be on both sides of the market, because they are looking not to defend a particular level, but basically to target volatility. And they have been quite successful in that.
So apart from these two factors, do you reckon any other reason why rupee has been falling?
Right now, as far as the global macros are concerned, there is no such big issue, except for the fact that, yes, Chinese growth has been a huge issue, and we have the US elections, and the US elections are tomorrow, and that's going to have some kind of short-term impact on the global market. So I think this could be slightly attributed to the US elections, because generally around the US elections, you tend to see the nervousness increase and a bit of outflows accelerate. So I think those are the factors which at this point could be playing out from the global macro side. As far as the domestic macros are concerned, I don't think there is any issue, and the oil prices are low. So that's again not a problem for India.
Right. Thank you so much for explaining that to us and making the picture clear for us. Thank you for joining us on the show.
Thank you for having me.
Thank you. Now, moving on, let's also talk about the other trigger that is being closely watched, and that's not only one, but two. One is US election results, and the other is Fed's rate decision. They are both slated for this week, and it's also important to note that these two triggers are intertwined. Neeraj is joining us to tell us how is that exactly. Neeraj.
Well, some Gavaikal researchers put out a note, and in which they are analyzing what the impact of the Fed election, or rather the US election outcome would be on the Fed electing what to do, let me put it that way. So they have painted two scenarios, obviously. The first one is a Kamala Harris win, and they say that out here the Fed could choose to sit on its hands. This is verbatim, of course, but effectively what they mean is that after the first rate cut, the Fed can choose not to do anything, because Democrats won't bash the Fed for exercising its autonomy. In fact, Democrats have gone out and said that a Trump presidency would threaten the central bank's independence. So it's very easy to assume that Democrats won't go out and tell the Fed that, hey, the Fed is doing something wrong, because they are on the plank that they want the Fed to remain autonomous. In fact, they said that the Fed may signal that further rate cuts may be data dependent. The scenario, according to them, is bullish for the US dollar and possibly for treasuries as well as growth stocks. Now, this is scenario one. Scenario two is in the case of Donald Trump getting elected. They say that the Fed will deliver the expected November cut, possibly following up with a cut in December as well. Now, there is a bit of a converse logic out here to this, because Gavaikal says that if the Fed doesn't do this, then it'll open up the Fed to accusations of political meddling. And this is something that the Fed has fought very hard to dispel the notion of. So even if it is not warranted, pressures may compel the Fed to go out and do a further rate cut in the month of December. Now remember, this is now looking slightly iffy, simply because the data in the US is not suggesting that there will be a series of rate cuts, something that was believed to be the case about 3 months ago. Also, there will be uncertainty if there's a Donald Trump victory on whether Jerome Powell will choose to stay on. Remember, the relationship between the two was very icy in the first innings. So don't quite know if that will stay the case or no. And this might happen almost immediately as per Gavikal as well. They don't rule out that possibility. Remember, so this is one of the views given by one of the houses, one of the research houses, but many more views exist, and it'll be really interesting to see how that will shape up, because this is happening, all of this is happening in a matter of 3 further sessions. The elections starting tomorrow, the FOMC decision or the verdict coming in on the 7th night. So very action-packed the next 3 days.
Thank you for that analysis, Neeraj. Now, the oil and gas index cracks as volatile global crude prices and weak Q2 earnings drag the index. Mihika is joining us with more details on this.
You have the Nifty oil and gas down about 3.8% intraday. When you talk about the top losers, you have companies like IOCL, BPCL, HPCL and Reliance Industries, and the Indian oil marketing companies have fallen over 4% intraday. Now when you talk about what's not working for the OMCs, well, up first is the volatility in Brent prices. While they do stand lower on a one-year basis, they have seen almost a 4% uptick in the past week itself, and the OMCs also posted a weak Q2 earnings. They have extended LPG losses. Now they did announce a commercial price hike by 62 rupees for the 19 kg cylinder. However, when you talk about, while this could offer some relief on the LPG losses that the companies have been facing, they have been facing majorly losses on the retail part of it, which is currently played on a subsidized race to the markets. Not you can see while this would be positive for the realizations, the stocks have corrected. When you talk about what's not working for Oil India and ONGC, well, production outlook remains uncertain. The companies are yet to post their Q2 results. And lastly, when you look at the city gas company pack, well, IGL, MGL, GGL all fallen 2 to 4% on an intraday basis. One of the major headwinds for the sector is the lower APM gas allocation, which impacts their operating costs and thereby their profitability. Analysts also expect near-term margins to remain under pressure, and the PNGRB notice to end network exclusivity is also a key overhang.
Thank you for that update, Mihika. Now we shift focus on two-wheelers. On the back of October auto sales, Puneet is joining us to tell us more on this sector.
I think it's getting corrected because of the larger market downside that we're seeing today. And, mostly I think two-wheelers as well as, tractor makers reported really strong numbers. So let's focus on the two-wheelers first. Hero MotoCorp is the first one, reported roughly 6.7 lakh vehicles, sold to dealers in the month of October. Now that's, a very strong growth of about 18% compared to the same time last year versus analyst expectation of about 11 to 12%. Now, another key thing is that, that Hero might be under pressure today compared to the other players. Build-up of inventory over the last 2 months. So in the month of October, they gave the dealers roughly about 6.7 lakh units as mentioned, but retails were about 5.7 lakhs. So that inventory build-up of about 1 lakh is going into November. In the previous month of September as well, there was an inventory of about 1,20,000 vehicles. So going into November, the inventory is significant. Although the company does sell a lot of bikes in a particular month, roughly 3 to 4 lakhs, I think that might be one of the key negatives for Hero specifically, but overall good set of numbers for Hero. When you move on to the other ones, which is TVS Motors, a really steady performance, about 12 to 13% growth over the last 6 months, and that continues in this month as well. Apart from that, the company has also regained its number 2 market share in the electric vehicle space, dethroning Bajaj Auto for the number 2 position. It currently has about 21% odd market share, and with the new lower priced variants such as the iQube, it essentially is looking to have better EBITDA margins in H2 as well. The third one is of course Eicher Motors, another big highest ever sales in one particular month for the company at about 1.1 lakh units. Now that's a growth of about 31% versus growth expectation of 22% by analysts. Now this is the first month of double-digit growth since April, so that's another positive for the company. And finally Bajaj Auto. Now there's a slight negative, domestic sales have fallen 8% for Bajaj Auto for two-wheelers specifically, and that might be one of the key reasons reacting negatively for the stock today. We spoke to the management and they have said that the festive season outlook is looking much better than they had anticipated. Earlier just 1 to 2% growth, and now they're anticipating 6 to 8% growth. But overall, all these players are seeing pressure in the market today, especially because of multiple factors that might not be in hand. But overall, the sales are quite positive for most of these two-wheeler makers.
Right. Thank you so much for that, Puneet. Now, On to some stock-specific action. Pharma stocks like Sun Pharma and Cipla are buzzing in trade today because of various developments, and Varsha is joining us with more details on this. Now, Varsha, let's first start with Sun Pharma. It has been down by over 4%. What's the backstory?
Well, yes, so if you see shares of Sun Pharma are under pressure. Now, this is because of their one product, that is Lexel-V. Now, a US District Court of New Jersey has granted a preliminary injunction in a patent dispute case over its hair loss drug, which is Lexel-V. Now, Sun Pharma can't launch this product until court ruling or patent expired. Now, this drug is used to treat hair loss. Now, the Sun Pharma has actually disagreed with the decision and they plan to appeal for the same. Just to give a little bit of background, they actually received US FDA approval with plans for the same product, with plans to launch in July and August, and the expected sales were around $200 million over the next few years. But now that has come in halt. Now, Lexel-V was actually initially developed by Concert Pharmaceuticals, which Sun Pharma acquired in Jan 2023 for $576 million. Let's see what brokerages are saying. Though the stock is under pressure, but the brokerages are actually positive on the stock. If you see Citi has maintained buy with target price of around 2080 with 12% upside, and they say that Lexel-V launch gets delayed, which is a setback to their specialty division, and delay may have impact on the near-term earnings, that is 3 to 6% of EPS, and they value Sun at 37 times March 26 EPS. Well, MK is also bullish on the stock. They have rated buy with target price of 2,350 with upside potential of almost 31%. Now, they say that Lexel-V's EPS contribution in FY26 is not that meaningful considering the launch linked cost, and the patent expiry and potential settlement support for FY26 launch will be as a base scenario according to MK. And they expect $40 million in FY26 from this product and $124 million in FY27, which is expected from this drug.
So now, while Sun Pharma has been down by around 3.5%, on the other hand, Cipla is up 1.5%. What, according to you, is creating the buzz around this stock?
Well, on Thursday we had a news wherein US FDA has classified Goa facility as voluntary action indicated for Cipla. On Thursday the stock was up around 10%. Now, this is the second best classification that a plant can get from US FDA. Let's see what brokerages has to say on that. If you see the Nomura on Cipla has upgraded buy from hold. Now, the target price is set at 1800, which determines 16% potential upside. Now, the Goa facility, according to them, has cleared by FDA as VAI, boosting potential approval for the limited competition drug called Abraxane, which is a cancer treatment drug. Now, a company will also focus on inhalers, injectables and peptides and ARVs in US with expected growth of FY25 to 27 according to brokerage house. Now, the higher valuation has been aligned with sector trends and regulatory progress, and Cipla stock, if we see, is up 29% over the past year but has lagged behind Nifty Pharma's 54% rise. And lastly, if you see, risk reward view favors Cipla with expected returns of 6 to 21% in 1 year, and the key risks according to brokerages are lower than expected growth in India and weaker US revenue and higher pricing pressure.
Thank you, Varsha, for that analysis. Now, Azad Engineering jumps over 8% after signing a 5-year pact with Mitsubishi Heavy Industries. Anushi is joining us to tell us more on this.
Right, so Azad Engineering is buzzing in trade today. Now, this is after the company has signed a 5-year pact with Mitsubishi Heavy Industries, and this pertains to supply of power turbine energies for about a 700 crore of a contract consideration that we are looking at. The execution period, as mentioned above, remains in the range of 5 years. But other than that, there have been other developments also for the company, wherein they've got a business award from US-based Honeywell Aerospace for high complex components. So phase 1 of these award also stood at about $16 million. So taking these orders in consideration, if you look at the company's overall order book, that has exceeded 4,500 crore as of November 24. Even if you look at some of the other key highlights of the company, they're developing a new facility which will start to add to the top line from FY26 onwards. That is 10x the capacity from what the current capacity holds. So with this, they have also reaffirmed the revenue growth guidance of 25 to 30% in FY25, and margin profile will remain in the 33% to 36% of a range. But to know more about what has happened, we also spoke to the management of Azad Engineering, Mr. Malkani, and he had this to say about the company's outlook forward.
Azad's relationship with our global OEMs has been there since our inception. So we started our journey with Mitsubishi. Talking about the current order, we started a journey with them in 2012, and 2012 till today, I think there are several milestones that we've hit. The business that we are into, we manufacture critical parts that are mission and life critical. So the qualification cycle is really long. So over the last about, so many years, we've spent a lot of time trying to qualify part after part, engine after engine. And today we've reached a point where we've qualified most of the parts for Mitsubishi, and, we are quickly ramping up. And as a commitment to our clients, we set up a foundation stone. Mitsubishi had laid a foundation stone for their new plant, which we are dedicating for them. This is a testament to it. So this long-term contract is them tying us into capacity, because for them, we are a growth supplier. Our wallet share is barely anything today, about 1% of our overall addressable market. So we are looking at building this up from here and quickly growing from 1% to 2 to 3 to 5%. So this has been, our thing. And this is a significant one, because today, as a best cost and quality supplier of critical parts to Mitsubishi, I think we are in the beautiful position where we're catering to the likes of these engineering companies, these large engineering companies, to cater to their global demand. So I think the market is huge, and I think this is just beginning of how we are able to scale ourselves. We'll be able to scale ourselves. So this is where it is, and this is not just with Mitsubishi. If you see this in our business, we've been signing long-term contracts across our product portfolio, whether it is in energy, aerospace, defense, or oil and gas, all the sectors that we are operating out of, because now the capacity is coming up. We are building the 10 times larger capacity, and sometime in the next financial year, we'll start producing our parts out of the newer facility. So it's all linked to what we've been talking about for these many years.
Right. Now, while that was the latest update on Azad Engineering, primary market gears up for a busy week. Mahima is standing by in the studio to tell us what all do we have lined up.
Right. So in terms of the primary markets, this week will remain completely action-packed. But before that, just to give a brief about how 2080 panned out for IPOs, where in 2080 somewhat, 85 companies raised around 1.21 lakh crore via IPOs in the main board space. And moving on, in 2081, in the first week itself, we will be witnessing 4 new main board IPOs which will open for subscription this week. And they'll be raising approximately 18,534 crore in the first week itself, and this amounts to roughly 15% of the 1.21 lakh crore raised by the 85 companies in somewhat 2080. Now moving on to what IPOs are set to open this week. First one is Sagility India, where the issue size is roughly 2,107 crores and the price band is set between 28 to 30 per share. In terms of the issue size, it's an OFS of 70 crore shares by the promoters of Sagility BV, and it is affiliated with the Equity Private Capital Asia. Now in terms of how the IPO will pan out, where in terms of pre-IPO, it has raised around 366 crore by selling 2.61% stake to 9 institutional investors in October around 31st itself. Moving on, the next IPO that will be in focus will be Acme Solar Holding, where the issue size is 2,900 crores. The price band is set between 275 to 289 per share. The issue dates are between 6th of November to 8th of November. It's a fresh issue of 2395 crore and offer for sale stands at around 505 crore. In terms of the next IPO in focus, it will be Niva Bupa Health Insurance. The issue size for this particular IPO is again 2,200 crores. Issue dates between 7th of November to 11th of November. It has a fresh issue of 800 crores and OFS of around 1,400 crores. And the price band for this particular IPO is set between 70 to 74 rupees. The next in line is the most awaited IPO, that's the Swiggy IPO. And for particulars of Swiggy IPO, the issue size size is 11,327 crores. The issue date, the IPO will open between 6th of November and end on 8th of November for subscription. The price band for Swiggy is set between 371 to 390 per share, and the offer for sale from the 11,327 crores stands at around 6,828 crores, and the fresh issue for this particular IPO is 4,499 crores. Now, in terms of how Swiggy's IPO has been so far, in terms of pre-IPO, a lot of celebrities have invested in Swiggy. We have Ramdev Agrawal, Amitabh Bachchan, Rahul Dravid, Madhuri Dixit, Karan Johar, who have shown interest in the Swiggy IPO in the pre-IPO segment itself. So all of these investors have already shown interest in the Swiggy IPO, and of course the retailers will set to show their interest on 6th of November till 8th of November. Now, how the funds will be utilized by the Swiggy management? Well, they'll be repaying the Scootsie amount of roughly 1,343 crores. They'll also be using some fund for their tech and cloud infrastructure of around 703 crores. Marketing spends will be approximately 1,115 crores, and they aim to reduce their debt of 137 crores also via the proceeds that they will receive via the IPO. Overall, in terms of valuation picture as compared to Zomato, Swiggy is valued at $11.3 billion, and Zomato's current market cap stands at roughly $26 billion. So Zomato's market cap is almost double of what Swiggy is being valued at right now. So that's a plus point overall also for Swiggy. However, Swiggy is around 4 to 6 quarters away as per analysts from being EBITDA positive. So that is one of the key metrics to watch out for when it comes to the Swiggy IPO. So this is the overall view of how IPOs will pan out in this week overall in the main board space.
Well, thank you so much for that, Mahima. Looking at that picture, it looks like quite an exciting week for a lineup of IPOs. Thank you. Now, as we wrap up on Diwali celebrations, let's take a look at the worsening air quality index in New Delhi and Mumbai. New Delhi's AQI touched 317 as of 8 a.m. today this morning as a blanket of smog plagues the capital. Meanwhile, in Mumbai, the AQI has marginally improved after plummeting to poor category. My colleague Juhi Jadhav joins in for more details.
Well, absolutely. If you go to see post-Diwali, the air quality, especially in Mumbai, is a bit worsened because the air quality is disturbed. Today morning, if you go to see, there was a smog enveloped the entire city, and the temperature had also risen. The temperature currently in Mumbai is 36.5, which is a bit higher than the regular temperature. The highest temperature that was recorded in Mumbai was 35, but now it has increased. The main reason for this is said to be Diwali, and due to Diwali, the firecrackers that were bursted. Due to this, the air quality has also deteriorated. Also, BMC has issued certain measures on the construction sites because the dust that goes in the air because of the construction site affects people, and this has also worsened in the health of few people.
Right. Thank you so much for that update, Joey. Now, that's all the time we had on this edition of Market IQ, but stay tuned to NDTV Profit for more news and updates.
Market veteran Ramesh Damani puts on the cephalogist's hat to get you the insight you need on the US presidential battle of the century. Will Kamala Harris claim a historic victory, or will Donald Trump march back into the White House?
According to polls, if Biden and Trump were running, I think Trump would have handily won. He was almost measuring the drapes to the White House even before the election.
What are the stakes for India and its investors?
The road to the 1600 Pennsylvania Avenue goes through Pennsylvania this time.
Tune in to US Election Watch with Ramesh Damani, exclusively on the NDTV network.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the large street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome to the Mutual Fund Show. I am your host Neeraj Shah, and in times like these, it's very important to get the right advice to try and understand what should you do with your mutual fund portfolios. Is it time to do some rebalancing? Is it the right approach to think of rebalancing, if at all? If you're putting in fresh money to work, what are the kind of funds that you should put your money to work? Because I'm guessing one thing is a given, that these times don't last forever, and therefore there should not be any change to the investment strategy if you have. There could be, or maybe there could be minor tweaks to it, but the process of investing, which a lot of Indian investors have gotten into a habit of, which is the systematic investing, should probably just continue. Is that true or no? Let's talk about this with Mrin Agarwal and Rishabh Desai. Both of them join me on the show today. And both of you, thank you so much for taking the time out and being with us, because you know it's an important day to be doing this show, because portfolios are reeling under pressure. Whether you're a stock market investor or a mutual fund investor, looking at your portfolios today, you must be a bit ruffled about how they are performing. So Mrin, before we talk about the how to rebalance, what should an investor do? Is this a good time to rebalance? Is it a time to sit tight? Or is it a time to continue the investment strategy as earlier, as difficult as it may be?
So good afternoon, Neeraj, and nice to be on the show today.
Thank you.
Well, as such, I think what is really important is to, first of all, build a portfolio that can withstand different market conditions. And, you know, it's very difficult if we have to keep changing our portfolio strategy or even doing the tweaking on a regular basis based on the news that's there in the market. It's going to be very, very difficult to actually manage a portfolio like this. So I would say, yes, we will talk about a couple of things that you can check at this point. But as such, I think if you have got your asset allocation right, and if your portfolio is as per your asset allocation, then I think you should just sit tight.
Rishabh, what would your view be?
Hi, Neeraj. First of all, thanks so much for having me on the show. It's been quite some time since we last did a show together. Yes, I think I more or less agree with what Mrin had to say. Like, you know, sticking with one's goal, one's time horizon, and most importantly, knowing your risk appetite and asset allocation is something what we advise our clients to do. I mean, if you have a long-term time horizon, then sticking with your risk appetite and your asset allocation is something what makes sense. So to answer it very simply, you know, sitting tight, sitting put during these volatile times makes more sense. You know, another thing what we recommend our clients to do is to diversify well. You know, a lot of people, you know, concentrate on product selection, category selection. But, you know, it is very important to diversify across different styles if someone is venturing into pure equity, like growth and value and contra. So, you know, that really helps in kind of like mitigating risk. And, you know, I wouldn't say, see, if someone is investing in pure equity, of course, there are going to be double-digit drawdowns. But at least, you know, in different market cycles, different products and different styles will outperform. So it's very important to diversify across different styles as well, Neeraj.
Okay, so, okay, Rishabh, let's start with you on this then. Is there a change of style that you are prescribing with the markets the way they have behaved in October or the way they behaved in October. So come November, the first few days, should people change their portfolios to a style which according to you might work better? And why is that so?
I think, what we recommend, and this is my personal portfolio as well, Neeraj. See, I invest 50% in growth and 50% in value. Right now, growth can consist of, say, like momentum and like pure value. Momentum and pure growth oriented strategies. And the value segment can consist of, value style and contra style as well. So I think investing 50% in growth and momentum and 50% in value and contra is something what I personally follow. I really don't need to bother too much about rebalancing too frequently, when markets fall, because see, currently markets have just fallen around 10%, which is very hardly. If you see the mid and small cap space, the valuations are still very expensive, right? So I think following a 50% growth and 50% value strategy is something what I would do.
Sorry, one more follow-up. Actually, let me first go to Mrin. Mrin, I heard your opening answer. I'm just trying to understand. Would you do some rebalancing, some fine tweaking, or are you comfortable continuing with what your strategy was, let's say 3 months ago?
Actually, Neeraj, that really depends upon what the investor has done. The issue that we really see today is, as always, trend chasing. And people have taken very high exposure to sector and thematic funds, for example, or they could be overexposure to, for example, mid caps or small caps where valuations are stretched. So the tweaking is going to really depend upon the stance of the investor. As such, I do recommend rebalancing only once a year at the end of the financial year. But at this point, if you are feeling uncomfortable as an investor, the first thing that you need to be asking yourself is that, are you ready for market volatility? Because of 10 to 15% drawdown every year is very normal, firstly. Second thing is that if you are not comfortable with this volatility, then you need to look at your portfolio and you need to have a look as to where you have a exposure that you want to cut down. So is it small cap? Certainly, I would say that if you're holding these sector funds and thematic funds, which has been the largest category that investors have acquired over the last 1.5 years, I think those are the funds that you should certainly look at exiting irrespective of the return. So clearly, it's a question of the investor's stance and whether they have the ability to stick on or not. And that said, investors should also keep in mind that equities are meant for the long term. So a little bit of volatility in the short term is not really going to make a difference as long as you have the ability to remain invested for the long term.
Okay. So, Bryn, let's try and understand. Let's assume it's an average investor who's watching us right now with average risk appetite and an average time horizon as well. So let's say the time horizon is not necessarily 1-2 years. But right now we are trying to gauge, or even people who might have shorter term goals, but this show is dedicated to people who have a proper mindset in mind of having to look at or investing with a 5-year, 7-year, 10-year period under an ideal case scenario, right? Should thematic funds be out of the window for the time being? Let me ask pointed questions to try and understand this. Should thematic funds be out of the window, or are there thematic funds which you are happy having?
I never advocate thematic funds. So yes, thematic funds should be out.
Okay. Rishabh, what about you?
I agree with Mrin.
Okay. That's
I really don't see any value addition in sectorial and thematic bets, Neeraj. See, unless and until if someone is investing in a product like Nasdaq 100 or a FANG Plus index, that's very different, because they are taking global exposure over there. And in today's time and age, I think having global exposure is very important. But see, if you see the thematic and the sectorial funds today, I mean, if I diversify well across flexi cap, multi cap, mid cap, and small cap, automatically, sectorial and thematic rotations is going to happen from the fund manager side, right? So I really don't see a lot of, cluttering your portfolio with too many funds. And of course, see, there has been plenty of liquidity over the past 2 3 years. Returns have been phenomenal, and investors are more or less pumping in money looking at to the past returns. So I think, following a consistent methodology, right? See, we are in this business day in and day out, so we can take probably sectorial bets or thematic bets. But a regular investor may not understand, when to invest and when to exit. See, there are two things. One is entering at the right time and exiting at the right time as well. I mean, look at the China market today, right? I mean, China is more or less like a theme what someone would want to invest, or look at the media sector. It is still negative today. So I think thematic bets is something what retail investors should completely avoid.
Okay, thematic funds should be avoided. So that's the first one. A lot of people are talking about slightly exotic options, and I'll come to those before I come to normal. So people buying into China ETFs, people buying into global funds or global ETFs as well. Is that an option currently while India is looking so volatile? Rushabh, I'll start with this one with you.
Absolutely. I think global diversification, especially in the US economy, is very important. I mean, if you see, look at the 10-year data, Neeraj. See, 10-year data clearly tells us that Nasdaq 100 has actually outperformed most of the broader Indian indices, which is the Nifty 50, Nifty 500, right? So I think having one foot abroad, especially in the US economy, looking at the giant nature, looking at the consistent returns, looking at the transparency what the US economy have. I mean, there are so many sectors and companies what India has not even seen. I mean, we are still developing, especially in the technology space. Look at Facebook. Look at Alphabet. These are like Apple. These are giant, super giant company with global presence. And let's not forget, how much ever we want to discuss that the dollar is deteriorating, but see, today dollar is a global currency. I will not deny that, and it's going to take a very long time for the dollar to come down the rail or come down from the primary currency, at least at this point of time. So I think having some global exposure, especially in the US economy, is something what I strongly recommend, Neeraj.
Rin, would you concur, and is it only US, or would you look at China ETFs? Would you look at some others?
I would concur with I would concur with Rishabh. And yes, I think US is a great market. In any case, it makes up a large part of world market capitalization. And as Rishabh pointed out, some great investments out there. So certainly I would look at some diversification into US markets.
How do you do this, Brin?
I'm sorry, Neeraj?
How would you do this diversification? An average investor wants to know how to take that exposure. What would you say?
I would say look at a S&P 500 ETF or look at the FOF route, either through the international fund, of course, through the mutual funds, not through direct stocks. Because again, if you're going to try and identify stocks directly out there, one is, the whole aspect of what you buy, but more than that, the tax reporting of foreign stocks in India is quite tedious and complicated. So, of course, through international mutual funds.
Okay, and is there, are there specific funds, Brin? I'll come to you, Rushabh, with the same question. Are there specific funds? These need not be an exhaustive list of recommendations, but indicative list of some of the funds that people can look at and study.
I would say the S&P 500 index fund is a good option if you want a more broad-based option. Because again, when you look at NASDAQ or when you look at FANG, it's primarily directed towards technology stocks. So I would say pick up a S&P 500 index that's available. And of course, study the tracking error to know how well the fund is actually optimizing the investment.
Rushabh, what about you?
I more or less agree with what Miren had to say. See, there are two ways to look at this, Neeraj. One is, unfortunately, there is a offshore limit by the RBI. $7 billion is the MF overall limit, and it's kind of exhausted today. Okay, so maybe there will be many funds which may not take additional lump sum money, maybe SIP, but not lump sum money, especially in S&P 500 or Nasdaq 100. See, what happens is that when investors try to buy ETF, when there is a restriction, the ETFs can also go at a premium because they are traded in the secondary market. So that is also something what investors really need to keep in mind, is that go for either pure index funds or the FOF route. Let the AMC manage that for you, because if you try to buy the ETF, you really need to see at what price the ETF is being traded. You don't want to buy an ETF which is trading at some 4-5% premium, right? It will not add much value to your portfolio. So I think keep your portfolios very simple, keep your products very simple. It'll be much more easier for you to track and monitor. So I think if someone wants to invest abroad, Nasdaq 100, either in the index fund route or the FOF, or also investors can look at Indian mutual funds with a combination of Indian equities and foreign equities, for example, like Parag Parikh Flexi Cap Fund or the SBI Focus Fund, because even Parag Parikh Flexi Cap Fund do still have around 17-18% towards the US economy. And I think around SBI Focus Fund does around somewhere around 9-10%. So I think including these funds which have Indian equities plus US equities should do the job.
Okay. So before we take some queries, I just have one more question. Would you guys advocate bringing in hybrid funds, balance advantage funds at the current juncture, or was the right time in the Nifty, on hindsight of course, or was the right time when the Nifty was at 26,000? Min, the question to you first.
See, again, we can't time markets. So I would say, again, it really comes down to the investor. If you cannot take volatility that's there in mid caps and small caps, of course, you have the option of investing in large caps through the ETFs, or you have the option of adding in the balanced advantage funds as well. Now, balanced advantage funds can be added at any time, because the beauty of the balanced advantage fund is that it keeps doing the rebalancing between debt and equity based on various quantitative parameters. And ideally, when markets are overvalued, then it tends to reduce the equity allocation. So I think, again, these calls cannot be taken basis volatility in the market or basis news that is coming out. This is a strategy that people have to decide, how much volatility they can take, how much risk they can take, and decide basis that. But yes, it's a good time for you to do that check in case if you're feeling worried about your investments right now.
Okay. And Rishabh, what's your view here?
Neeraj, see, if someone wants to play defensive, right? I think the best way to do is to be more aggressive during market corrections. See, what happens is during market corrections, you are going to accumulate more units, number one. Once you accumulate more units in the future, see, markets, we have seen that, the downfall or the negative periods have been much more lesser than the positive periods in the equity markets, right? So I think once the units have been properly accumulated during bull markets, the returns will be enhanced. And most importantly, once that volatility phase is waved off after a couple of months or maybe a year or two, the future downside will be very well protected during future market correction. So I think number one, if someone is investing in pure equity, I think the best way to play defensive is actually to be more aggressive and invest or pump in more money during market conditions, market corrections. See, if someone wants to go into dynamic asset allocation funds or balance advantage funds, one should be very clear why they are entering in these products. One is that they cannot stomach volatility. That is a good way to go into balance advantage or dynamic asset allocation funds. Number two is that they don't want to time the markets. They don't want to keep on rebalancing from time to time. And they want to leave that to the fund manager to do the job, right? From equity to debt and debt to equity. So once someone has a moderate risk appetite, someone who cannot stomach too much of volatility, and someone who does not want to time and rebalance on a regular basis, I think balance advantage funds and dynamic asset allocations funds are meant for them.
Okay, let's try and get in some queries going. G2 is the first question is from G2. Don't quite know the age, but G2 is ready to invest 50 lakh rupees into mutual funds with a long-term view. Considering current market conditions, a good time to invest, or should G2 wait until the US election outcome is over? Well, G2 is just a couple of days out, but he needs guidance on timing and strategy. Mrin, you want to help?
So as I said, you can't time markets. First thing to keep in mind that long-term view means that you should be in it for at least 7 to 10 years. So that's my definition of long-term. Secondly, in terms of strategy, well, again, it depends upon how much risk you want to take. But I'm presuming that you're looking only at equity mutual funds right now. I always suggest that take a combination of index, like a Nifty 50 index fund, a flexi cap fund, a mid cap fund, and a small cap fund. Because in this you're getting exposure across the different market cap segments as well as some amount of international exposure. Of course, provided you choose funds like Parag Parikh, which have international exposure. But I think one of each of these categories is honestly good enough. In the portfolio, it will give you large cap, mid cap, small cap, and international exposure. And always remember that it's very important to be diversified among fund houses as well. So don't choose all funds from one fund house, among market caps, and at the same time, remain invested in this for the long term. That is what is really important.
Okay. Rishabh, is your advice different?
I think, investing around 50-60% into flexi cap and the rest can be divided into mid and small caps. This is something what I would recommend because it gives a good blend of both these spaces, which is the large cap space and the mid and small cap space as well. So I think, first of all, staggering investments is something what I would recommend because we don't know where the markets are going. I mean, the earnings have also been quite flat on a year-on-year basis. So I think we may see some kind of stagnation or the correction could continue for some more time. So I think don't just look at the US elections. It's a combination of everything, which is the global picture and plus the domestic earnings of how they are panning out to be at this point of time. So I think staggering investments over the next probably 3 months or so, this is something what I would recommend. So 50-60% into flexi caps and the rest can be divided into mid and small caps.
Okay. Second query is from Aman Mehta. Aman is 33 years of age. He says I invest 1.24 lakhs a month. Interesting number. 1.24 lakhs a month through an SIP route and is looking for long-term wealth creation, ideally a CAGR of 15%. Is requesting a review of the portfolio. The goal, Mrin and Rishabh, is a 15% CAGR, as I said, and the portfolio has PPFAS flexi cap, which is about 31,000 rupees a month, SBI Contra 31,000, HDFC mid cap 31,000, and Tata small cap 31,000. So those are the 4 funds, 31,000 each, 1,24,000. Is this a good portfolio or does it need some changes? Rishabh, I'll start with you on this.
Neeraj, I think overall it's a brilliant portfolio, good blend of growth and value. It's not too cluttered. Perfectly what I had actually thought, Parag Parikh Flexi Cap and SBI Contra are like Flexi Cap strategies and one mid cap and one small cap. I think just one change I would like him to make is the HDFC mid cap opportunities fund is a giant fund today. It's around more than 60,000 crore fund. So I think the AUM, especially in the mid cap space, can hinder the future performance. So I think I'm not telling him to redeem from HDFC midcap. I'm just telling him to stop the SIP in HDFC midcap and start an SIP in a moderate AUM midcap fund. So probably I would suggest him, instead of HDFC midcap, I would suggest him to go for an Edelweiss midcap fund. I think that's the only change I would recommend. Otherwise, the portfolio looks perfect to me.
Okay, portfolio looks perfect. And Mrin, very quickly, your advice before we move on to the next query.
So I concur with Rishabh that the portfolio is fine. I think somewhere he needs to possibly look at moderating his the returns expectation. I do see a lot of investors who think, SIP, if I do, I'll get 15%. So I think it's better if you have slightly lower returns, lower return expectation of, let's say, 10 to 12% over, having this goal. It's nice to have a goal of 15%, but yeah, that's the only point that I'd like to make.
Okay. The next query, Mrin, is from Abhijit Das, age 22 years, wish to start investing 10,000 rupees a month into SIPs with a 10% annual step up. Horizon of 20 years. Can you suggest some funds?
Well, firstly, I'm happy to see that he's having this step up plan in place because one of the key things which I advise on is to focus on the corpus because we are resuming average returns of 10 to 12%. So then a good way to actually build corpus is the is the actual annual step up, right? In terms of funds, given his age being 22 and the fact that he has an investment horizon of 20 years, I would say take some good risk, take higher risk, and look at mid caps and small caps. So maybe like Mire mid cap, SBI small cap. These are a couple of funds that I would suggest.
Okay. Very quickly, I'll take one more query, and Rusha will have to make this quick. But Rajesh Chaudhary, age 36 years, is investing 90,000 a month through SIPs across 10 funds. 24-year time horizon, expectation of 14% CAGR. Please review the portfolio. Rusha will have to make this quick. The goal, as I said, 14%. The funds on your screen. PPFS FlexiCap 10,000, Mira Asset Consumer 10,000, HDFC Midcap, about 10,000 in HDFC Manufacturing, about 5,000 coupled with the HDFC Pharma, Nippon India Growth, Nippon Multicap, HDFC AMC, Nifty B. So about 9 funds.
So there are two things, Neeraj. One is there are too many funds, which I would recommend to trim down. Number two is that he's concentrating on certain AMCs, which is HDFC and Nippon. I think diversifying across different AMCs and different products is something what I would recommend. I'm not a very big fan of the sectorial and thematic funds. So manufacturing, pharma, consumer. I think these are the funds I would like him to kick it out from his portfolio. Stick with 4 or maximum 5 funds. I don't think there should be more than five funds in one's portfolio, in one's core portfolio, especially on the equity side. So probably stick with FlexiCap fund. Introduce one more FlexiCap fund, like probably say Franklin India FlexiCap fund. He can stick with Nippon India Growth Fund, and I would encourage him to introduce one more small cap fund, probably say like Kotak Small Cap Fund. But just stick with 4 or 5 funds, 2 or 3 FlexiCap, 1 mid cap, and 1 small cap, Neeraj.
Got it. Okay, both of you. That's all at the time that we have on the show. Thanks so much for taking the time and being with us and giving us your advice. Really appreciate your time. That's all the time that we have on this leg of the mutual fund show. Stay tuned to NDTV Profit.
Market veteran Ramesh Damani puts on the cephologist's hat to get you the insight you need on the US presidential battle of the century. Will Kamala Harris claim a historic victory, or will Donald Trump march back into the White House?
According to polls, if Biden and Trump were running, I think Trump would have handily won. He was almost measuring the drapes to the White House even before the election.
What are the stakes for India and its investors?
The road to the 1600 Pennsylvania Avenue goes through Pennsylvania this time.
Tune in to US Election Watch with Ramesh Damani, exclusively on the NDTV network.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the large street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide? is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just
Hello and welcome. You're watching Market IQ here on NDTV Profit. I'm Harsh Saita. Quick check on where markets are at. Some bit of pressure, but holding on now around the 1.5% lower on the Nifty 50 benchmark. And pressure, of course, still very much there. Let's pull up the contributions in terms of which stocks are contributing to these losses. And on the positive side, far and few, right? Just look at Dr. Reddy's, Cipla, Tech Mahindra, less than 5 points in terms of, or rather less than 6 to 7 points in contributions overall from those 3 to 4 positive contributors. And you look at the negatives, Reliance Industries, if you can pull up the intraday chart for that one, and followed by HDFC and ICICI as well. Some of the heavyweights really packing a punch. 3.3% lower on Reliance and holding fort around that zone. HDFC Bank has now slipped over 1% lower, and ICICI Bank also down around 1.4%. So the heavyweights coming to the fore in terms of dragging the indices and the benchmark especially lower. That's how it's essentially playing out. Let's pull up the Nifty mid cap as well as the small cap. The Nifty mid cap down 1.3. So some bit of outperformance there. And the Nifty small cap also down around 1.9. So some bit of underperformance there. But the Nifty mid cap and small cap has recovered from the day's lows. But the recovery very small. I mean hardly visible essentially on that intraday stock chart. Let's pull up the advanced decline as well. See how that's essentially playing out. The VIX is spiking 7% now, and the advanced decline, there you go. The VIX up around 7% thereabouts, but the advanced decline, 400 advances now. So slight bit of improvement, maybe 100 stocks or so have switched sides from declines to advances since the morning. But nonetheless, the breadth of the market looking increasingly weak. In terms of quickly on the sectoral heat map, if we can pull that one up, 1% lower on the bank, Nifty, 0.5% lower on IT, and around 1% lower on Pharma and PSU Bank as well. But outside of that, you're seeing losses really clocking on some of the other indices, especially look at the Nifty Energy down 3%. And the Nifty Realty also down nearly 3%. So some of those indices really taking a knock in trade today. But let's stick to the energy index. We have Mihika here to give us more context on what's happening, especially on the Nifty oil and gas front. Mihika.
You have the Nifty oil and gas down about 3.8% intraday. When you talk about the top losers, you have companies like IOCL, BPCL, HPCL, and Reliance Industries. And the Indian oil marketing companies have fallen over 4% intraday. Now, when you talk about what's not working for the OMCs, well, up first is the volatility in Brent prices. While they do stand lower on a one-year basis, they have seen almost a 4% uptick in the past week itself. And the OMCs also posted a weak Q2 earnings. They have extended LPG losses. Now, they did announce a commercial price hike by 62 rupees for the 19 kg cylinder. However, when you talk about, while this could offer some relief on the LPG losses that the companies have been facing, they have been facing majorly losses on the retail part of it, which is currently played on a subsidized race. So the market's not, you can see while this would be positive for the realizations, the stocks have corrected. When you talk about what's not working for Oil India and ONGC, well, production outlook remains uncertain. The companies are yet to post their Q2 results. And lastly, when you look at the city gas company Packwell, IGL, MGL, GGL are all fallen 2 to 4% on an intraday basis. One of the major headwinds for the sector is the lower APM gas allocation, which impacts their operating costs and thereby their profitability. Analysts also expect near-term margins to remain under pressure, and the PNGRB notice to end network exclusivity is also a key overhang.
Okay, thanks for that, Mika. So some bit of pressure creeping in on those indices, but we also have Azad Engineering. The stock on a day when indices are under pressure is doing very well. You had an order win come through. Anushi is here with all of the details on that one. Anushi, you spoke with management as well, so give us some context.
Right, Harsh. So Azad Engineering, as we speak about that, it is in buzzing and trade today, and this is after the company has signed a pact with Mitsubishi Heavy Industries, and this is for a consideration of about 700 crore that we are looking at. So this current phase that they've described as a 700 crore of order is for supply of power turbine engines, and the time period for the same is about 5 years. But other than that, also there have been a lot of recent developments in the company which needs to be focused on. First is the company had received a business award from US-based Honeywell Aerospace as well for high complex components, which was about a $16 million of an order that we are looking at. So considering these recent order wins, the company's order book, according to the management, now stands at about 4,500 crore. They're also developing a facility which is about 10x the times of current capacity which is there, and this will be operational from FY26 onwards. So a lot of incremental revenue that we are expecting from there onwards, so which will also help the company maintain its near-term to medium-term outlook of about 25% of a growth, 25 to 30% of a growth that is mentioned. Other than that, if you look at the margin profile of the company, they've guided for a 33 to 6% of EBITDA margin. So this is all that is happening in Azad Engineering. Aerospace and division also on a strong pickup as we go forward to the other quarters.
Okay, so that's on Azad Engineering. Stock is up 10.5% in trade, so doing very well. 5-year pact with Mitsubishi, driving those numbers, or rather the stock price higher. But Anushi, stick with us. We also have Max Estates, very interesting note coming through, and lots of developments also coming through. They've hiked their guidance as well. Just talk us through what Investec's view is on this one.
Okay, so Investec, they've reiterated the buy rating on this stock, and this is at a target price of about 700. So 25% of an upside that we are looking at. A lot of key details that they've highlighted in their note which stand out. First is the FY25 guidance, which they've raised about 4,800 to 5,200 crore as compared to 4,200 earlier, and this is after the company Estate 360 launch, which garnered a much higher response to their pre-sales as they had anticipated earlier. So this takes this along with the expected GDV of about 4,800, company is set to beat its FY25 guidance. What we should look out for is also the launch of fourth tower, that is Estate 128, which is set to aid the FY25 numbers also. Other than that, the company has also received the NCLAT approval for its Delhi 1 project, and this is in sector 16B, spanning about 2.5 million square feet. If you look at the GDV value of this one, that stands at about 1,500 crore. The company also, post its QIP conclusion, they're sitting on a cash surplus of about 1,400 crore, which is aimed to be used for augmenting the development pipeline further and for looking at the other ingredients which will help to scale their GDV pipeline, that's the gross development pipeline, even further. So at 1.3x the NAV size, Investec believes that the company's risk to award ratio still remains on the favorable side. So this is what is happening in Max Estates as well.
Okay, so plenty moving. Max Estates up now almost 2.5% in trade on the back of that. But PVR Inox numbers came through, and if we can have the intraday chart, we saw, or rather are seeing quite a bit of pressure where the stock is concerned. Rucha is here to break down the numbers as well as give us perspective.
Hi,
Thanks, Harsh. So PVR Inox is down about 8.5% in terms of intraday low levels, and the volumes are trading at 3.5 times its 30-day average. Now, this is largely on the back of underperformance of the film industry, and the latest movies are also not doing well for the stock as such. Well, the 2Q earnings say that the revenue was down about 19% and margin came in at about 29.5% versus 35.3%, and it posted a net loss of 11.8 crore versus a profit of 166 crore. Now, the results came in back about 3 weeks ago, and if we look at the performance since the results, we'll see that the stock is down about 11% in last 1 month and is down about 10% in last 1 year. So in last 1 year, the stock has not given much of returns, but when we look at the analyst recommendations, 16 have a buy rating, 4 have a hold rating, and 2 have a sell rating on the stock. But the return potential over here is healthy at about 24.5% for the stock. But last time during the earnings time, when we spoke to the management laid out few strategies such as the passport strategy, the re-release strategy, which is really doing well for PVR Inox, and it also stated that the second half will largely be better because of lineup of good movies. But we'll see whether they are able to maintain up to the mark as stated by the management or not.
Okay, thanks so much for that, Rucha. Quickly switching focus to Sun Pharma. That's another stock under some bit of pressure, 3% lower in trade. Of course, off the day's lows, so some bit of recovery on that one. But Varsha here to give us context on what the order from the New York District Court means for Sun Pharma.
Well, thanks Harsh for that. So we are seeing pressure on the stock. Now this is on the back of only one product, that is Lexilvi. Now the US District Court of New Jersey has granted a injunction in a patent dispute case against its hair loss drug, that is Lexilvi. Now what does this mean? Sun Pharma cannot launch this product Lexilvi until court ruling or patent expiry. Now this drug is used to treat hair loss. Just going on the background, so actually they received this US FDA approval with plans for July to August launch, and the expected sales were around $200 million for the next few years. If you see, the Lexilvi was actually developed by Concert Pharmaceutical, which Sun Pharma acquired in Jan 2023 for $576 million for the same product. Now the Sun Pharma cannot launch this product, and this is the reason we are seeing the pressure on the stock, because the market size or the revenue potential was actually good when it comes to this product. Now let's see what brokerages are saying. Despite the pressure in the stock, brokerages are actually bullish on the Sun Pharma, wherein Citi has maintained buy with a target price of 2080 with upside potential of 12%. Now according to them, Lexilvi launch gets delayed, which is a setback to their specialty segment, which was actually the growth driver for the business. Now delay may have impact on the near-term earnings of 3 to 6% of EPS, and this may impact competitive dynamics as well. But they are valuing Sun Pharma at 37 times of March 26 EPS. While MK, if you see, again bullish on the company with target price of 2,350, upside potential of 31%. Now they say that Lexilvi EPS contribution in FY26 is not that meaningful considering launch linked cost for the product, and the patent expiry and potential settlement support in FY26 is actually is the base scenario that they have expected, and they are expecting $40 million in FY26 from the product and $124 million in FY27. This figure, so basically $200 million is expected from Lexilvi in next 2 to 3 years.
Okay, thanks for that, Varsha. But stick with us because Cipla is the other one in focus. Now this one ran away in trade on Thursday, Varsha. Again up 1.6% in trade today as well. Your sense with regard to what's happening here?
Well, on Thursday, there was this news wherein US FDA had classified Goa facility as voluntary action indicated, and that's the reason we saw 10% uptick in Cipla on Thursday. Now, this is the second best classification that a plant can get from US FDA, but let's just look out what actually brokerages are saying. So, we have Nomura, wherein they've upgraded to buy from hold. They've raised their target price with 16% of potential upside. They say that the Goa facility facility, which is actually an important one from a product perspective. So Goa facility clears FDA as voluntary action indicated, boosting potential approval for limited competition drug called Abrixin, which is a cancer drug. Now a company is also focusing on inhalers, injectables, peptides and ARVs, which will be actually, these are the driving growth for Cipla for FY25 to 27, and the higher valuation is aligned with sector trends and regulatory progress as per the brokerage. Now Cipla stock, if you see, is up 29% over the past year, but has lagged Nifty 50 Pharma, which is up 54%. Now risk reward is actually, risk reward is favoring Cipla with expected returns of 6 to 21% in 1 year. But they've also highlighted the key risk, that is lower than expected growth in India, weaker US revenue and higher pricing pressure. So that VAI status which the company has got, this is actually driving the stock price that we are seeing.
Okay, thanks for that, Varsha. So Cipla obviously doing very well again in trade today, 1.5% higher on a tough day of trade. Puneet joining us as well, because M&M is the top gainer on the Nifty 50 today, also the top contributor on the Nifty 50 in terms of positive contributories. So Puneet, give us context, M&M, the numbers overall, as well as what brokerages seem to be suggesting or taking away from those numbers.
Well, definitely, it was a positive set of numbers, and for a change that the market is reacting positively on an auto number, because we've seen, two-wheeler makers also report decent set of numbers in this particular month, but the stocks are down today in trade because of larger issues. So for M&M specifically, it was a really strong month. 25% growth reported by the company in this particular month, and when we make it a comparison with someone like a Tata Motors as well as Maruti, that's the stark divergence that you can see for this SUV maker. For Tata Motors, it was roughly about 0.4% fall in sales, so largely flat compared to the last year. Maruti grew about 3%, but that stark divergence for M&M is one of the key things that's driving positivity for the stock overall in the market as well. Now, we do know that they launched the Thar Rox also in this particular quarter on 15th of August. That got roughly 1.7 lakh bookings in just the first hour, and just for context, the company sold roughly about 60,000 Thars last year. So 3 times of their annual capacity or annual sales of the older model is what they got just in the first hour. So that's one of the key things as well. Apart from that, as you rightly said, we had a couple of brokerages that came out with a note today on it. Goldman Sachs was the first one. They have a target price of 3,600 on the stock, 27% upside from the previous close, so a good upside from this current market levels as well. And they have mentioned that the company's new SUV order backlog with battery EV launches is also one of the key positives on the stock as well. They've also said that the launch as well as backlog of the company in terms of order book is much higher compared to its peers as well, and they're expecting a 20% EBIT and 100% free cash flow generation for the company over the next 3 years. The essential part is that Kotak has also upgraded the stock to a buy from an ad rating earlier. They have a target price of 3,150, which is slightly low from the previous target price of 3,300. Now, they said that the M&M is continuing to expect and generate a lot of growth going forward as well, and outperform the industry across the benchmark, including the peers of Maruti as well as Tata Motors. They've also said that the successful new launches as well as brand development has been one of the key strategies post Anisha era, and that seems to be continuing and bearing fruit as well. Apart from that, they've said the tractor segment has been one of the key things as well. It showed roughly about 25% growth in this year as well, and they have maintained that they've just slightly cut their target price in this particular year. That's basically because of lower LCV volumes, but traditionally the PV business has been doing very well. So overall, slightly higher discounting period going on, but very positive by both these brokerages on M&M, and results expected on the 7th, and it's expected to be a bumper result in this particular quarter as well.
Constructive on M&M, both brokerages, but more importantly, M&M's fallen from those 52-week highs. Thanks so much for that perspective, Puneet. Let's switch focus. Acme Solar Holdings set to launch its IPO on the 6th of November. 2,900 crore crore IPO. The price band is set at 275 to 289 rupees per share. And Sajid Mangat of our team spoke to the management of the company. Listen into a slice of that.
We are going to use the primary proceeds for repaying the debt of our subsidiaries. And of course, as we reduce the debt, it will help us grow and execute the capital expenditure we plan to undertake in next 2 years.
Give us a sense of your balance sheet, Ankit. What is the kind of consolidated borrowings or debt on your books as of now?
So as of June 24, our consolidated debt in the book is roughly 9,200 odd crore, and our net worth is around 1,940 crore as of June 24.
Okay, and is it possible to give us how much of that debt will come down by?
Yeah, so basically the business model that we have is for every project, right, that gets financed, we raise financing, right? It's a continuous process. But now, as we speak about this particular IPO, our primary issuance is 2395 crore. Out of that, roughly 1795 will be used for repayment of one or more project subsidiary. So you can see essentially from this portion, 1795 project loan will come down. But for the balance project that will be commissioning, of course, we'll be raising debt to fund those projects as well.
Give me a sense of the kind of business that you operate today in terms of operations. How big is it, and what is the kind of projects which are work in progress or under construction?
Sure. So, Sajit, we are an independent power producer. We are the pure play renewable IPP, independent power producer, and we are in the business of supplying power long term to government entities. We solely supply power to government entities, and we have been doing it for last 13 years. So we are an integrated player who develops, bids, develops, finances, and operates the power projects, all the renewable power projects. We have been only in the solar space for the last 13 years. And we have focused on this space because the generation in solar is much more predictable than other sources of renewable power. So from last 13 years, we have executed close to 3.7 gigawatt peak of solar projects. Of course, we have divested around 1.8 gigawatt peak of solar projects. So we have around 1.8 gigawatt peak of solar projects with us today. And as we speak, we have energized a 1.2 gigawatt plant in Jaisalmer, which is 1.8 gigawatt peak of capacity. So aggregating that, we have around 3.6 gigawatt peak of energized projects. And they are all selling power to government entities. So for the 1800 megawatt peak we had before this new plant, we had, Solar Energy Corporation of India is our main customer. And in terms of the operations span across 13 states, 12 states of India. We have plants across India wherever, because historically, as you see, the states used to call the bids for their own procurement. And 2015-16, we had Solar Energy Corporation, which came into being. And then the procurement of electricity became centralized. And that really led to a large growth in the sector because the credit rating of the procurer was immediately elevated because SECI is a AAA entity. And starting 2024, government has really elevated the program in terms of 50 gigawatt procurement every year. And these 50 gigawatts will be procured by 4 central government entities, which are called Renewable Energy Implementation Agencies, being SECI, NTPC, NHPC, and SGVN. So going forward, all of our projects are with these 4 entities. So whatever we are constructing beyond 2025, which is more than 2.5 gigawatt, is all with these central entities. And the historically, it was around 50% of our capacity was with state and 50% was with center.
Well, plenty of very interesting IPOs, and among a swathe of that, you also have Niva Bupa. But as we wrap up the show, let me quickly go across to a slice of that conversation with the company. Aiming to raise around 2,200 crore in the upcoming issue. Sajit Mangat again spoke with the management of the company regarding their plans with regard to the money that they're going to be raising. Listen in to a slice of that.
In terms of the objective of raising this 800 crores primary, Sajit, our purpose as Niva Bupa is to give every Indian the confidence to access the best healthcare. So we're very excited about investing, in the growth opportunity of health insurance in India. And this 800 crore, is to support our growth plans over the years and to meet our solvency requirements. That is the main reason that we're raising this money during this issue.
Your solvency is already around 2.4, if I'm not wrong, at the end of June. How much will the solvency go up by? And when you say that it's for the growth requirements for the next couple of years, how many years are we talking about?
So yes, our solvency will go up, and to some extent we will be overcapitalized because of this primary raise. But the idea is to take care of future growth requirements and We believe that as we execute well, we will continue to be able to grow and also become self-sustaining as a company with this capital increase, Sajid.
My understanding is that Bupa and your other promoter, Fettletone, is offloading shares as part of the OFS. Fettletone becomes an investor and it gets declassified as a promoter post this allotment. And how much stake will be Bupa holding after this fundraise?
So Bupa, as you know, Sajid, is a long-term shareholder. They are more than 80 years old as a company, and their only reason for existence, so to speak, is for the customer. That's their corporate structure. The only reason Bupa has an offer for sale in this issue is to accommodate FII headroom. As you know, FDI cap is 74% in India, and to accommodate the considerable interest that we're seeing with FIIs, Bupa has agreed to an offer for sale through the issue. But that's the only reason that they are bringing down their shareholding. True North, as you know, is private equity. They have completed 5 years of their investment here, and there is the remainder of the offer for sale is coming from True North.
What will be the FI headroom, if I may ask, as part of the entire process?
So Bupa will, after this, OFS will be at 56%. So 74% is the FDI limit. So that's the kind of headroom we have.
And True North will not bring in any FI limit, right? Because it's a AIF based out of India in that sense. I understand that Fettleton has sold 10% stake to Axis Bank. So how much Axis Bank would be getting as part of the proceeds?
So Axis is not a direct shareholder in the company, Sajid. They are only through Fettleton. So whatever is the dilution that will be there for Fettleton, in proportion of that, Axis will get diluted.
And what will be the Fettleton stake after this?
That will be in high teens.
Okay. And they will be holding the entire thing through an SPV for some time.
That's correct.
Give me a sense of the kind of business growth that we are seeing, because in Q1 we saw net loss, and I understand that is because of some of the seasonal factors that came in. But how is the business growing in? Because we've seen that Q2 from some of the industry players that are there has been a very tough quarter and very highly competitive quarter for many of them.
So as far as business growth is concerned, as of August, and this is publicly available information, Sajid, our growth rate is about a shade over 30%. So we continue to grow well over market growth rates. Our Q1 financial results are out, and if you look at our Q1 numbers year-on-year basis, we continue to grow at 30% plus, and there's also been a significant improvement in our overall operating metrics, and this is publicly available.
Market veteran Ramesh Damani puts on the cephalogist's hat to get you the insight you need on the US presidential battle of the century. Will Kamala Harris claim a historic victory, or will Donald Trump march back into the White House?
According to polls, if Biden and Trump were running, I think Trump would have handily won. He was almost measuring the drapes to the White House even before the election.
What are the stakes for India and its investors?
The road to the 1600 Pennsylvania Avenue goes through Pennsylvania this time.
Tune in to US Election Watch with Ramesh Damani, exclusively on the NDTV network.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
It's tough out there. You don't need me to tell you that because it is looking weak. The only respite, if you will, from the brutal selling that we've seen today is that we are off from the lows of the day, if that is any solace. The intraday of the Nifty will show you that we are no longer as weak as we were sometime during the lows of the day. Though I must say the Bank Nifty is steadily headed lower and it was down about 0.6, 0.7%. Now the Bank Nifty is trading in or around the lows of the day, if you will, about 1% lower. So here there is a small issue, of course. The VIX has jumped up in trade, so India Volatility Index is certainly higher. Was about 7-8% and still about 6.5% as we speak. And the market breadth has looked terrible, really. But Tamara, let's speak about the broader end of the spectrum. Just get the advanced decline ratio once before we get to the heat map, because the market breadth has a yawning gap and it's only stayed wide. So 1:4.5 or 2:9 maybe in favor of the decliners. Let's get the heat map there too. Maybe 2 or 3 stocks. Oh, okay. There's 7 stocks in the green. M&M and Tech Mahindra standing out. There is Cipla. So M&M and Cipla both have a brokerage note to themselves. But aside of that, hardly any solace there. On the flip side, look at the kind of cuts. It's not really 7-8% to a heavyweight, etc. It's across the board. You're seeing some serious gashes with upstream oil plagued by ONGC and Reliance Industries, and even BPCL, so downstream, upstream oil and gas, as a sector which has been one of the worst performing sectors in our series gone by. Also has a tepid day today. Hero MotoCorp brings up or sums up what's happening to autos. So Hero, Bajaj Auto looking very wobbly in the session today, and consumption names like Titan as well as new specific names like Sun Pharma also down. So net, when Reliance, HDFC, etc. are all looking so wobbly, you wouldn't have anything else, the market do anything else but stay lower. Tamanna, broader markets though under a vicious grip of a sell-off which is not quite abating.
You know, it's very tough to find the silver lining today, Neeraj, and unfortunately it has continued its slide. There seems to be no factor which will actually give any real relief. So while we're looking at the small cap about 2% down, we should pull up all the sectoral indices for a second just to give you a sense of how painful the market is today. The India VIX is the only thing which is in the green, which is not a good sign at all. That's up about 6%. Energy stocks, oil and gas, energy being hit the most. Slight bump up in crude prices. Remember, OPEC Plus has decided to push forward its date for production increases from December. They were supposed to start in December. They've said they'll push it by a month. So you've had an increase in crude prices, but does it justify the kind of cuts here? Perhaps not. Some impact on, your HPCL, BPCL because of LPG prices, but really no real reason for this. The Nifty reality, look at that, about 3% down. Infra stocks, media stocks. I mean, there's nothing which has been spared. The broader indices really taking the brunt of it. In fact, IT relatively looking better, one of the weaker segments from the morning. I want to just pull up the market breadth for a second before we go to the top gainers and losers in the broader market. No point of talking about specific stock stories because this is today a wide sell-off. Look at that. 413 advances to 1,775 declines, and that gap is only yawning. Look at some of the key gainers and losers, and you will just see, maybe if you're looking for a reason, those who have declared results even a few days ago, the market really coming down heavily on those companies whose numbers were not up to the mark. I mean, that's probably one of the reasons that Polymedicure would be seeing an 8.5% cut. Vodafone, complete pullback. It was, remember, up in the Diwali Muhurat trading session. No reprieve there. PVR Inox, one would have thought decent kind of an upside, and for the Diwali movies, Singham, etc., but no relief there at all. And Imami, is this a consumption story? Is this something else which is hurting it? Not too sure. Brigade, Bharat Dynamics, there is really no relief here. On the other side, some stocks which are showing a spot of green, and let's talk about some of them. Gillette, again, good number. So if I had to draw some kind of a, reasoning for this, perhaps that could be one. Fine Organics, also decent set of numbers. So maybe that's why we are seeing this kind of a bump up in few stocks, but they're far and few in between, to be honest. What are the key reasons for this sell-off? Before I hand back to Neeraj and we continue with all of the conversations, we need to talk about what is happening. Disappointing Q2 earnings. The reason we've picked this as number one as a reason, even though there's so many global issues right now, because the underlying problem and weakness in corporate earnings doesn't go away. Let's move on and see some of the other factors. Nervousness ahead of the US poll definitely is one. It's too close to call. Market intelligence tells us that a Trump win would be preferred by Indian markets. Does that happen? Does that not? We do not know. The US Fed meeting outcome, I don't know why it's bothering the street so much. We had conversations this morning. It was very clear that no matter who the next US president is, a 25 basis point cut is something that the Fed is pretty much clear it's going to do by the 7th of November. And the Sell India, Buy China strategy is a big one. Remember, important set of meetings in China this week, which will decide on what is their fiscal measure to boost up their economy. Will that lead to even a greater outflow of foreign funds from India into China is the big question. So these are some of the factors, Neeraj, but whichever way you may slice and dice it, the fact that this is a very tough market to be in, and the question is, what do you do here?
Yep, let's ask our guests this question. What are they doing in a scenario like this? Kunal Shah, Senior Technical and Derivative Analyst at Sharekhan, with us on the technicals and the derivative positions. Kunal, good having you. Thanks for joining in. The news somewhat not quite starting off on the best footing on the first full day. But what to do now? 1.5% lower, not at the lows of the day, but certainly under pressure. What do you do on the benchmark indices?
Good afternoon, Neeraj. I think definitely this is something what was expected from the markets, where we were advising our client as well that at least in the mid cap and the small cap space, don't try to be very aggressive in this market. If I talk about Nifty, even there the weakness is visible. On the technical charts, if I talk, then Nifty has already given a head and shoulder breakdown on the technical charts. The target for the pattern comes at around 23,500, 23,400 zone, which again coincides with the 100 DMA of the Bank Nifty as for the Nifty as well, which is placed at 23,456. So I expect this fall to continue towards 23,500, 600 zone to test that 200 DMA for Nifty index. Post that, we can see a good recovery in the markets towards again 24,000, 250, 300 levels on the upside. So my sense is still we are in the last leg. Probably this last leg will still continue. The mid cap and the small cap space is something which I will say that it is an avoid even at the current levels. We might see further correction on the downside. So be very stock specific on mid cap and small cap. But index, I think more 400 points on the downside, max 400 to 500 points on the downside is what I see from the current levels. And post that, we can see good recovery on the higher end. For the Bank Nifty index, now this has been the resilient, but you can say all credits to HDFC and ICICI for maintaining those levels for the Bank Nifty. If they would have not been there, then Bank Nifty would have been much lower right now. So for Bank Nifty, I think 51,000 is what I'm looking at. If that is breached for the Bank Nifty as well, then we might see further correction towards 50,000 levels as well. So Bank Nifty, it's a wait and watch situation over here. Nifty is still on a sell on rise. Whatever pullbacks you get, utilize that to sell. We can test levels of 23,600 to 500 on the downside.
23,600 isn't that far, right, Kunal? So, okay, but fair call. You're playing from a trade perspective, 250, 300 points. You would want to bat for that. I heard you say a different tone for the Bank Nifty. Would you go long today on the Bank Nifty if you're a high risk trader?
No, definitely not, because two things, Neeraj. One is, if we look at the rollover data, Bank Nifty witnessed decent rollovers compared to its 3 months average as well. But still, Bank Nifty on the higher end is facing rejections around that 51,700, 800 zone if I talk about the spot levels. So till the time we are not surpassing that decisively, I don't see Bank Nifty going on the higher end. And if that 51,000 mark is taken out decisively, then we will see that 1,000 point fall in Bank Nifty as well. I think Bank Nifty is still in a wait and watch. I'll not be on the buy side. I'll not be on the sell side. If the levels get breached, then our trade would be activated. But for Nifty, it's active. It's a sell on rise. Whatever rallies you get, utilize that to sell the market.
Okay. Kunal, as difficult as it may be, what are the stocks that you're recommending this afternoon?
See, I think pharma is a space where one should be in such volatile markets. So over here, first pick on the buy side would be on Syngene. So Syngene in this weak market has been showing a lot of strength. The stock has maintained its support of 840, 830 zone on the downside. In fact, in today's weak market, on the daily chart, if you see on technicals, it has formed a hammer candle on the verge of a breakout above its 20 DMA. So clearly short-term momentum could build up in the stock. So this is a buy from the current levels, keeping a stop loss of 842, looking for targets of 900 to 920 on the upside. The second one will be on the sell side, and I think that comes from the IT space. IT is looking weak, and here pullbacks could be utilized again to sell the sector. For me, the first pick over here would be Birlasoft on the sell side. So Birlasoft has already given a breakdown below that 550, 560 zone, which was the support. So now again, if you get pullbacks into Birlasoft, utilize that to sell Birlasoft, keeping a stop loss of 565 and looking for targets of 520 to 500 on the downside.
Okay. Let's go across now to Puneet on what I think, it's tough to pick one sector that is doing badly, but let's pick out auto because auto has been in focus. Puneet, all the auto sales numbers are out. Some didn't look as bad as the others, but nevertheless, that's not really helped the Nifty auto and key auto companies, is it?
Yeah, definitely. But, the numbers weren't so bad. When you look at it was actually pretty good numbers. I think just getting a hit on because of the whole market correction and the magnitude of factors that you highlighted at the start of the show. So when you look at the two-wheeler specifically, Hero MotoCorp 18% volume growth, Eicher Motors 31% volume growth compared to last year. Somewhere like a Bajaj is the only one which is missing just about 2 to 3% volume growth on an overall basis, while TVS is another big winner, 13% volume growth in this particular time frame in this month, specifically in October. And I just looked at the data on Vahan as well. So this data you see on your screen is of course wholesale data, which goes from the companies to the dealers. When you look at the Vahan data as well, the retail sales have been quite positive. So while Hero has wholesale 6.7 lakh units in this particular month, they've also retailed 5.7 lakh units. So that's another positive. Eicher Motors, another one which I took notice of, 1.1 lakh units sent to dealers. 95,000 was sold on on their retail channel as well. So that's another key positive. While TVS and Bajaj, legacy players maintaining inventory of about a month to like 35 days. So, it's a big positive because inventory correction might be something that we'll, get a lot to know about in this week itself, because companies are expected to report results as well. Mahindra comes on 7th, Tata Motors comes on 8th. So, we might get a little more flavor on the inventory, but overall, the numbers are quite positive. I also want to bring in a tractor segment, the first particular month in this particular fiscal year of double-digit growth, and it's, performed very handsomely. So, escorts is the one which I want to talk about. 20% growth in volumes in this particular year. It's a build-up going into the Rabi crop season. M&M also another key player in the tractor segment as well. About 29% growth versus just about 16 to 17% growth that was expected by analysts. So the tractors and the two-wheelers are key big winners. Within the four-wheelers, it's of course just Mahindra that's driving the growth. 25% growth in this particular month itself, and that's on the back of 20% growth in the last 2 months also. So overall, they've built up inventory, and that's retailed faster as well in this particular month. So another key positive. While commercial vehicle is a sector that's not picking up at all. We've seen Ashok Leyland report a 10% fall, but overall, I think the tractor segment and the two-wheeler segment, goes very hand in hand with lower inventory, newer launches, as well as faster sales that we've seen in this particular month. So it will be important to see whichever results are still left of what happens, and I think commentary from both Mahindra and Tata Motors by the end of this week, both expect to report results, will be something to watch out for.
Okay. We in fact spoke with Bajaj Auto's Rakesh Sharma on the sales numbers for October, and he talked about his focus on the 125cc category and the growth outlook for the second half of the year. Listen in.
In our area of focus, which is the 125cc plus segment, in this 30-day festive period, compared to the similar period last year, our growth in retail terms is above 20%. And at an overall level, it is, 11 or 12% in motorcycles. In electric vehicles, it is in triple digits. Now, so that is what the festive is. Now, obviously, a festive period, if the average sales in a month is about 8.5%, 9% for the year, arithmetically speaking, the festive period is about 12%. So obviously, there is advancement or postponement of sale, which bumps up the sale like in the festive, like you're saying. But when you start to see the festive could have gone worse, and then that would have put some question marks about the months to follow. But I think the customers coming back to the purchase cycle in such strong numbers indicates that after the sort of dip which is expected in November and December, things should be looking good, back to the kind of forecast we were doing of 6 to 8% for the fiscal.
So that was a view coming in from Bajaj Auto. Kunal, anything in the auto pack that you're seeing attractive at these levels? M&M, of course, is the only outlier, but anything else?
Definitely, from the current levels, if I look for the entire autos as a sector is looking quite weak. So I think it's a sell-on-rise rally for the sector in whole. Today, the sector has taken the support at 200 DMA, but I think even that will be eventually breached on the downside. So I think utilize pullback to again sell the sector. We might see further downside for the auto sector towards 23,000 mark. So for me, yes, apart from M&M on the technical charts, nothing is looking great at the current levels. Even in Tata Motors, TVS Motors, or an Eicher Motor, these all are looking weak on the chart. Pullbacks could be an opportunity to sell them.
Okay, well, let's get in. A big market voice, Prateek Agrawal, MD and CEO of Motilal Oswal Asset Management Company, Johnson, on the show today. Prateek, so good talking to you today. At the outset, a very happy news somewhat. Unfortunately, it's not quite starting off in a good note, Prateek. Before we talk about the long-term, Prateek, what's the cause for the concern today? We heard talk of some margin calls getting triggered, some other reasons, but it's come as a surprise to a lot of people, the ferocity of the down move today.
Yeah, so that's been a surprise to us as well. Maybe to some extent, the motor trading, the spaces which were buoyant are correcting, so that happens on a lower volume and more domestic participation versus institutional. So some bit of that may be happening today. But yes, the sharp downtick was not expected. What one also needs to look at is arbitrage funds and their ability to keep absorbing large blocks, especially in the space where F&O exists. If the arbitrage yields fall, the attractiveness of that space versus the usual debt funds reduce. and that can impact the ability to absorb large blocks also. So maybe some bit of that also happening.
Wow. Okay. You reckon that could, okay. Pratik, you reckon that could also be a technical factor. Now, if that is indeed the case, would that be long-lived, or would it be a fairly swift corrective move because of, I mean, essentially the arbitrage funds-led piece that you spoke about?
No, so when the selling pressure is high, the premiums reduce. If the premiums reduce, arbitrage returns would fall, and that will cause that space to be less attractive versus let's say a liquid fund or an ultra short-term fund, and that sets in its own dynamics. It can change very quickly if there is some positivity and we get a day or two of market up move and the premiums get restored. So that is how it is. Now, arbitrage used to be a not so large space, but now two funds together maybe a lakh crore with rest of the funds also of a reasonable size, though smaller. But we have got two very large funds.
Pratik, hi, good afternoon. Tamanna here. I'm just wondering what the strategy right now is. Are you sitting on the sidelines waiting for a further fall? Is this the time to start deploying cash or wait?
No, so we as a house typically stay almost fully invested. I keep saying this, we are focused high conviction house. Our single position is minimum 2.5% by design, which means 2 to 3% cash is one position cash. So enable trade, we may have that kind of cash, but that's about it. So we stay fully deployed. We are currently fully deployed, but we are deployed in spaces where we see earnings growth trajectory to be very high, not for one quarter, but for 2 to 3 years, a large delta over index. Our belief is over time, market follows earnings growth, and I think that is the source of outperformance. So we are not there in many spaces. So this result season hasn't been too good, especially for index heavy spaces. Well, we are not there.
What would you look at? Anything that you think is now at the right valuations? I mean, if you look at some of your banking majors have taken quite a tumble, especially in the private bank space. Anything there which is now beginning to look attractive, Pratik?
So I have a differing view there. In any economy, when the economy is being tested, it is just the start of a emerging market kind of a phase. Banks are the easiest way for foreigners to enter into a country, and one finds bank as a part of total market cap, bank as a part of index, increasing over a period of time and then peaking out. To have an index which used to be 35, 36% lenders, can it get higher than that? Okay, is point one. As the economy diversifies, as people have other sources of capital, private equity markets, etc. Banks don't remain the same commanding position that they used to have, and that should be reflected in their position in the index as well. Second is valuations itself. Now, just look at it. We have some cases where the market caps may be 2x the lending book. Think of it. Market caps are 2x the lending book. So you lend $100, your market cap increases by 200. Is that sustainable? It does prompt you to think. So while a lot of people would say, on P's they look cheap and etc. Maybe banks are just simply making too much of money, and over time, with so many of them doing practically the same thing, competitive intensity should result in lower margins. But whatever it is, our view on banks is a tad different from that of the street. So our funds are actually reasonably low on banks, and that's worked for us. Maybe a quarter hence, maybe 2 quarters hence, when the NIM pressure reduces and we start to see them deliver earnings growth in excess of the index earnings growth, we would up the banking exposure. But as yet, we are below 10% in most funds.
Prateek, one follow-up. There are murmurs of the index hitting levels of 22,000 as well, and not surprising people. This was not in the realms of conversation when we were at 26,200 just about 40 days ago. So now, one, could it be possible? And anything is possible, of course, but do you believe it's realistic? And what could be the factor? Would it be the earnings-led disappointments thus far, or is it something else if indeed we are headed there?
No, so one, I don't believe we are headed there. Two, I think the market has digested most of the difficult news, difficult phase that was presented before it. So, the result season, everybody knew monsoons are very good. If the monsoons are very good, we tend to work a tad lower. For example, coal would be mined a tad lower. Etc. So there is a small slowdown in economic activity. Now, post monsoon, the reverse happens. You get a good crop, the farm incomes go up, there is cheer all around. So it is one phase to the next. Then in first quarter, you got general elections. Obviously, government spending did not happen. We looked at government balances with RBI high and liquidity in the system being low. Now you have seen the deficit figures in the first half well under control, which means in the second half government spending should also increase. Third, you were looking at very large NFOs, IPOs, QIP kind of a supply of paper. Now, some of the largest are behind. One or two are left. That's about it. So one more source of investing, which was probably reducing the flow to the secondary market, would also be out of the window. So many things which impacted market sentiment over the past 2 quarters are now behind us. Yes, one new thing has emerged, which is US bond yields moving up and sharply. So just a month back, there was cheer. They had cut rates by 50 bips. Bond yields had come down to 3.75. And people thought there would be more cuts, and we will get even lower. But now, as we speak, they are at 4.3 in the US, and that is what is causing a lot of money outflow from the country into probably back into the US. So I think that is something that we need to look at. As we see bond yields there stabilizing, I think the selling pressure here should also stabilize. That said, we do believe the bulk of the selling pressure, in terms of intensity, is probably behind us. We can't be getting 7,000-8,000 crore a day kind of outflows. I think if 3,000 to 4,000 crores a day kind of outflows happen, it should prove to be way more sustainable.
Okay. Thank you so much, Prateek, for joining us. It's a tough afternoon, but we'll have to wait and see what the next few days are looking like. Mainly, OMC and gas stocks also in focus. They are sinking in trade. Mihika joining us now with what the key triggers are for the fall. Yes, Mihika?
You have the Nifty oil and gas down about 3.8% intraday. When you talk about the top losers, you have companies like IOCL, BPCL, HPCL and Reliance Industries, and the Indian oil marketing companies have fallen over 4% intraday. Now when you talk about what's not working for the OMCs, well, up first is the volatility in Brent prices. While they do stand lower on a one-year basis, they have seen almost a 4% uptick in the past week itself, and the OMCs also posted a weak Q2 earnings. They have extended LPG losses. Now they did announce a commercial initial price hike by 62 rupees for the 19 kg cylinder. However, when you talk about, while this could offer some relief on the LPG losses that the companies have been facing, they have been facing majorly losses on the retail part of it, which is currently played on a subsidized rate. So the market's not, you can see while this would be positive for the realizations, the stocks have corrected. When you talk about what's not working for Oil India and ONGC, well, production outlook remains uncertain. The companies are yet to post their Q2 results. And lastly, when you look at the city gas company pack, well, IGL, MGL, GGL all fallen 2 to 4% on an intraday basis. One of the major headwinds for the sector is the lower APM gas allocation, which impacts their operating costs and thereby their profitability. Analysts also expect near-term margins to remain under pressure, and the PNGRB notice to end network exclusivity is also a key overhang.
Okay, well, that's OMCs for you, though. It's pointless singling out any one bucket because everything is done really, really badly. The only contrast is, interestingly, that two-wheelers are down under pressure today, and we have a four-wheeler name in Mahindra & Mahindra right at the top of the pile when it comes to the Nifty 50 gainers. Nevertheless, we'll take a break on that note. On the other side, try and get you some trading ideas, more trading ideas. Kunal is with us, of course. Joining us will be Siddharth Khemka on the fundamentals.
Market veteran Ramesh Damani puts on the cephalogist's hat to get you the insight you need on the US presidential battle of the century. Will Kamala Harris claim a historic victory, or will Donald Trump march back into the White House?
According to polls, if Biden and Trump were running, I think Trump would have handily won. He was almost measuring the drapes to the White House even before the election.
What are the stakes for India and its investors?
The road to the 1600 Pennsylvania Avenue goes through Pennsylvania this time.
Tune in to US Election Watch with Ramesh Damani, exclusively on the NDTV network.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy.
Back with India market close, and let's get before we get to this, let's just get the intraday of the Nifty, because for whatever it's worth, we are now above 24,000 on the Nifty, so should pull up that piece before we get to this. Not that it's big solace, but I think today the street was scared that we will close below 24,000. If you remember, viewers, Kush Bora in the morning said that if a close happens below 24,000, then it's a big negative. Now again, different people may view this differently, but you certainly view this as an afternoon of a little bit of a recovery from the lows of the day, for whatever it's worth. So this is one part. I do want to see if we can pull up the European indices and just see what they are doing in trade today as well. There are some internal pressures, of course, because of which India has reacted the way it has. Europe is absolutely flat. So the world markets are not gyrating as badly as the Indian markets have corrected. So a bit of recovery that should be cheered for sure. Okay, we'll get to that and some specific stocks which might be bouncing. So we'll show you some breakout alerts as well. But before that, I think an important piece to note is what the Fed, what the election, US election impact could be on the US Fed impact. So Gavekel Research has put out this note, and they put out the two scenarios. Obviously, Kamala Harris win versus Donald Trump win. Kamala Harris win, they say the Fed could choose to sit on its hands, not literally, but just do one rate cut. And even if they do that and then do anything further, Democrats won't bash the Fed for exercising its autonomy, because that's their allegation that Donald Trump will harm the autonomy of the US Fed. Let's move on. So they say that if this victory happens, that the Fed may signal that further rate cuts will be data dependent, and the scenario is bullish for the US dollar and possibly for treasuries as well as growth stocks. Now what happens in the case of a Donald Trump victory? Again, Gavekel view, but they say that the Fed will deliver the expected November cut, possibly following up with a cut in December, even if the economic conditions may or may not warrant it, because the Fed will want to show that it's autonomous. It is something that Fed has guarded very, very zealously, their autonomy. And if they don't do that, then it will open up the Fed to accusations of political meddling. They also say that it's uncertain whether Jerome Powell will choose to stay on after this victory were to happen or no. So it's really interesting, because this one election outcome will have multifold impact on multitude of things and not just the US economy, and hence it becomes so important to look at and analyze.
You know, very, very interesting, Neeraj, on what the Fed could do. I don't know if the Fed is going to change its stance depending on who is POTUS, and by 7th of November, you might not even have a full picture, because remember, it's possibly going to be quite a close contest. But we have also pulled up what the key promises are from both sides, and that becomes important as well. Trump, for example, is saying universal tariffs on all imports from all countries. He wants sweeping immigrant deportation programs. He wants to deepen corporate tax cuts, so that perhaps good from the corporate's point of view. Kamala, on the other hand, Kamala Harris wants a hike in corporate tax rates, a federal ban on price gouging in the grocery sector, and she also wants subsidies and tax credits for housing, childcare, and other segments like that. So which one is better for India, which one is worse, really becomes a big question. Siddharth Kemka joining us now, Motilal Oswal Financial Services. Siddharth, great to have you on. A bit of recovery in the market perhaps in the last few minutes, but do you think that you will wait and watch before saying that there is some relief happening?
Yeah, hi, good afternoon, Tamanna. So if you see, yes, I think what Neeraj was saying, that the entire street is hoping for a close above that key psychological level of 24,000. But nonetheless, today's market definitely shows the weakness, the inherent weakness that we are going to witness. So I'm not too sure how the technical levels are going to support, but definitely if you look at from a fundamental perspective, there is not much of support. We are in the midst of the earnings season, and we did an interim review of shorts for the coverage companies, and for the 166 companies that are within our coverage, we saw earnings declining by about 8% for the quarter so far, which is lowest in the last 17 quarters. So you can see the kind of pain we are seeing in the quarterly results, and the pain is also there in a lot of large cap names, and we have seen the punishment that the market has given. So I would hold on to my horses and say that the market is likely to consolidate for some more time. there are global headwinds in terms of who will become the next US president, what will the US Fed do, and following that we also have the RBI, and when will the RBI rate cut cycle start. So I think the major event trigger for the market would be the budget, which would now be only in the 1st of Feb, where we could find some solace in the terms of the government spending, which has been lacking in the H1 of this financial year, and which is a major factor driving the slowdown in the economy. So I would say that the market is likely to consolidate for some more time.
Okay, so Siddharth, is there anything that you would want to pick up right now? Some of the heavyweights really getting pummeled today, especially on the banking side. You have RIL as one of the top losers. Would you wait to find the bottom in this market right now as far as the heavyweights are concerned?
So, Tamanna, very difficult to say where the bottom is. My approach would be to look at the results. Companies where the results are already out and they have come out good, that is the space or pockets where I would like to be in. For example, we got very strong numbers from ICICI Bank. So I would say that that's a good stock to keep accumulating. It's very difficult to keep an hazard on what the results may come, and we have seen the kind of disappointment and punishment once the results are out, and even a slightest of miss, the market is very harsh this time to kind of punish any disappointment in kinds of numbers. So clearly, wherever the results are out, which are strong results, valuations are comfortable, those kind of pockets are places where I would start looking at accumulating over the next few weeks.
Okay. Kunal, just one quick follow-up to you. This little bit of a bounce that we've seen from the lows, right? We are no longer 2% lower, 1.23, 1.25%. Are there any stocks which are showing strength which interest you enough to make a small trading position on the long side?
I think PSU banks is something which is looking strong. Probably here we could see some upside in the coming days as well. So structurally, if I look at a long-term perspective, I think PSU banks are showing early signs of bottoming out. We need to have further confirmations on that. But for a trade perspective, Bank of Baroda looks good at the current levels. 252 is where currently the stock is trading. One can keep a stop loss of 247 and look for targets of 258 to 260 on the upside.
Okay, there's a little bit of a pickle for Sun Pharma individually as well. The stock has certainly fallen post the US court putting an injunction on the launch of one of the company's drugs, apparently in the hair treatment space. Varsha Johnson with the details. Varsha, 2.5% lower. Is this a big deal or is this a one-day event that will pass?
Well, Neeraj, for short term, yes, it is kind of a big deal because the product which the court has banned, they were expecting almost $200 million of revenue. Now, the US District Court of New Jersey has granted a preliminary injunction in a patent dispute case against its hair loss drug, Lexel-V. Now, Sun Pharma cannot launch this product until court ruling or patent expiry. So basically, the company has disagreed with the decision and they plan to appeal further. Now, US FDA had given approval to Sun Pharma for this product with plans for July to August launch, and the expected sales were around $200 million over the next few years. Now, just to give a background, Lexel-V was initially developed by Concert Pharmaceuticals, which Sun Pharma acquired in Jan 2023 for $576 million and so basically because of this product, management was expecting good revenue from this product, and even analysts were expecting almost $200 to $250 million of revenue from this product. So maybe the launch will be delayed. So because the expiry of the patent is around December 26, so they won't be able to launch this product before that. But a few of the brokerages are actually bullish on this company. So for example, Citi has maintained buy with target price of 2080 with upside potential of 12%. They say that the delay may impact the near-term earnings of 3 to 6% of EPS, and they may impact competitive dynamics